Hit it.
It's Friday, October 6, 2023, episode 223. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the great pleasure to welcome back to the show two of our previous guests. But instead of them being interviewed individually, they're coming on as the new dynamic duo that makes up the Damp Spring team. Andy Constan and Jimmy Jude join us to talk about what they see in the markets, how one of the largest hedge funds in the world missed selling 38% 10-year S&P volatility, and where we are headed when we leave the higher for longer island. Then we have never been more in need of Patrick's voodoo magic in talking charts.
And then we end with the no stupid questions. And finally, we announce the winner of Skin in the Game. God, it feels like it's taken forever for this day. But and then, folks, we might even stick around and drink some beers. So, Lena, hop on. What beer am I drinking this week?
So this week, Patrick is drinking from Amsterdam with Love, Heineken.
That's right.
And Patrick has already been drinking way too many. Oh, it's been a while since we've kind of you've come into it hot. Listen.
So I'm in Dubai at the W Hotel in the Palm, and they have never heard anywhere in this city of craft beers. Like this is like. Well, this city is amazing, but don't come here for craft beer. This is 100% a fact. And so I'm drinking a Hotel Heineken, and I'm playing the lottery because 50% of Heinekens taste like skunk. So it's we're gonna find out whether. It's interesting. They have a great tour, and they only use 4 ingredients. I get the whole thing, but it's literally a lottery when you're drinking this. It's whether or not you're going to get a skunky Heineken. It's
You're such a beer snob. Okay, let me do the side effects and let's get this show on the road. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the bullish thrust fadeaway, the 1 pip drip, and the straddle waddle.
Oh, jeez.
Jesus, those sound bad.
All right, let's get these guys on the line here.
It's our great pleasure to welcome to the show the two partners at Damp Spring, Andy Constan and Jimmy Jude. Thanks for coming, guys.
Hey, thank you for having us.
Thanks for having us, Kevin. Good to be back.
It's going to be a lot of fun. We got a lot of things to talk about with the markets. But before we do, let's just talk a little bit about how you two came together. Which one of you wants to tell the story?
Jimmy's better at that one.
It's really kind of an interesting story because, I met Andy maybe a couple of years ago on Twitter and realized, he had so much to offer and opened up a dialogue with him because I had a lot of questions. It's hard for an old prick like me to, find a mentor. They're most of them are dead. So it was, we established a relationship of, talking about the markets, me asking a lot of questions. Andy is a great educator and he loves educating people, which is, which most assholes in that position don't want to say shit to anybody, So, the relationship progressed, and there was a lot of strengths and weaknesses that we shared, and so as we talked the markets over the last year, we established this rapport, and we really started to kind of zero in on a lot of really good calls. This is before we started to work together. Just a really great dialogue, and we didn't always agree with each other, and so there was a lot of debate, and I really liked that, because I come from an atmosphere where there's really no debate. It's just ball busting, pit trading or trading floors or whatever. You know what I mean? It's just God forbid you voice an opinion in front of somebody. You know what I mean? You'll have 10 guys telling you you're an asshole, So it was really nice, and it was refreshing. And we started to we really started to have success on our theses and when they ran together, and so it seemed like a really natural progression. Plus, for a guy like me, like Andy is, he's a super intellectual. He's well read. He's everything I'm not. So it was, like I really loved like getting a guy like that in my corner. And and since we've joined up, like it's made me a better trader, and I think it's maybe made Andy a better trader. And it's just really been working out really great.
Well, I see when I went to your website here, it says Andy is the CEO, CIO, and Jimmy Jude is the contributor, creator of content, Sparkle, and Good Cheer.
That's right.
So, Andy, what does Jimmy bring apart from Good Cheer and Sparkle?
Yeah, so, again, Jimmy and I have been talking for years. I think an old, now retired Twitter account named Canadian Soccer Mom put us in touch with each other. And, we've been back and forth. And I've watched Jimmy on Twitter and just, interacted with his great output that he puts out that sort of, plumb the depths of the experience of being on the floor and being in the oil markets, et cetera. And at the same time, I also saw him doing work that I really don't do. I'm not, I'm pretty confident I have no short-term alpha in terms of executing my trades. And my personal experience, and part of this is very rewarding, and being on Twitter and being able to interact with so many great thinkers and my clients. But, I didn't really, since leaving Brevin Howard, I didn't really have an environment, COVID, et cetera, in which I, could have that sort of collegial dialogue with somebody who was my partner. And so, I always expected to expand the Damp Spring product and bring in verticals that I didn't cover. And the most natural one is sort of, really close to the market, understanding of technical analysis, and not just the squiggly lines, but sort of how it fits together with a thesis. And, using that along with the macro thesis that I've developed to sort of get us into the best position we can at the right time. And, that's what we're exploiting so far, but it's far beyond that sort of very narrow thing. Jimmy is the life, I don't know Jimmy from when he was younger, but I imagine him being fairly much the life of the party. And I was sort of behind the bar or being in the DJ booth or doing something that would be, sort of more like antisocial. Wow. And so just that alone is a nice combination.
Andy, whatever you do, don't take after DJ Saul.
Yeah,
it's
no,
been too long in the DJ
It's
booth.
been a long time since I DJ'd. It's been a long time, but I used to a lot.
All right, so let's talk a little bit about the trades, and I want to start with Jimmy's because Jimmy had a call back in May 27 when everyone was bearish as AF, and the S&P kept popping up, up against 4,200, and everyone was talking about how it was going to go down. And he said, it's going higher. He was one of the few people I saw that did it. And he says, 4,200 is going to be great support after we take it out. Sure enough, it took off. It exploded higher. That was a great call. And now we're back at 4,200. Is this the support that we were looking for? And where are we headed from here, short term?
All right, I'll take that first because I was the one who talked shit about that. So, I think like when I originally was talking about this level, and in reality, this is when like Andy and my relationship really kind of went to the next level, was during that period when we were like banging up against 4,200. And I called that and I said, oh, Jesus, it looks like it's going higher. And I remember like DMing Andy and saying like, listen, and this is the way most of our DMs start. I have no fucking idea why this is going to happen, but I see this like about to happen, like why, and then I ask him like, why the fuck, why am I seeing this? What the fuck, and then Andy kind of fills in the background. All right, maybe this is okay. All right. And he takes it from there. So, like I always, like that's such, it's just markets, just the natural, organic movements of markets, when we spend that much time in an area, I know we're coming back and going to back test it. Like I have 100% confidence in stuff like that when, no matter how high it goes up, I know we're going to revisit this area. So we're revisiting it now. Like, I don't know if we've actually revisited it.
Oh, really?
Really yet. You know what I mean? Like we kissed it. You know what I mean? But there was like a kiss you'd give to your aunt, like there was no tongue down there. I really expected some tongue. So, and I'm not so sure, like, we're not going to get that yet. Like I'm still in that, like why? Because I do fear that, some kind of bounce out of this area, then runs into some earnings bullshit, and we go on this like false dawn wild goose chase again, to the upside. But in the grand scope of things, I feel I don't think we're out of the woods yet. I don't think like, that's I'm not taking a victory lap like, oh yeah, we just touched 4,200. I told you that, motherfuckers. No, you know what I mean? We really didn't touch it. I don't, we could have some unfinished business down there.
Okay.
So that's where I'm at right now.
Okay. And Andy, you've had some great calls. You've been bearish both bonds and stocks. And recently I saw you make a little bit of a change. You've decided that finally, I guess down 42% on the long bond was enough. I'd love to hear your kind of thoughts in terms of trading on a little bit shorter term, why you think the bonds might have bottomed here.
Yeah, sure. So I've been, I mostly was short twos and spoos for the first 6 months of the year. And, that trade worked a little bit. It didn't really pay much. But come July 31st, I was set up short long-term bonds and short stocks, expecting the government to announce a very large issuance that was going to surprise the market. And that really basically has played out. And we've seen 10-year bonds, 30-year bonds rally, sell off about 80 to 90 basis points from 4% to close to 5%. And, that's taken the legs out of the equity multiple while the economy is still pretty strong. And so equities are outperforming. They're down 6-7%, and, Russell's down like 12 or 13%. And so the average portfolio is doing quite poorly. So then the question is, why do you buy bonds? And the answer to that is, I had an expectation that their bonds were going to reprice based on this new supply. And I had an expectation it was going to be about the amount of basis points that it's been. And it's overshot by 10 or 20 basis points. So, I covered my short when it reached my target. And now it makes sense for the month of October to sort of play the overshoot.
One of the things that I saw you offer was this kind of chart / table / I don't know how to describe it, but it's got SPOOs on the top, 10-year note yield on the left, and then you have this soft island, and you have an area, 4,500, SPOOs, and then you have this higher for longer island, and then finally the recession island. And I must say, in terms of visualizing and kind of explaining to people that kind of relationship between those two assets, that was genius. I thought it was really well done. I thought that was a terrific, one of the best charts out there. What was the kind of thought process behind creating that chart? And do people like it as much as I do?
It's very popular. I think it's one of I made it more as a joke, but it actually has rung true perfectly as the last 9 or so months have played out. It really seemed to me that the new year, January in particular, you saw a rally in both bonds and stocks, which priced in the expectation that that inflation was going to magically disappear, and we were going to see no significant drop in the increase in the unemployment rate. And, that's the classic soft landing. And so what do you expect in there? You expect equities to be 4,500, and you expect bonds to be, 3 3/4, 4 1/4, maybe 4, maybe. And so, that creates a region on that chart of S&P by 10-year notes that, basically we stayed at for most of the last the first half of this year. And, my expectation is that landing this economy softly, where you have inflation, go to target and not have a recession, is just very, very difficult. And pricing the market at 4,500 and 4% just wasn't going to hold. Now, there were two possibilities in my eyes. One, the economy is stronger than most people expect, and then the Fed's going to have to do more, and long-term interest rates are going to have to rise, and that's going to pull stock prices down. And that's been my higher for longer island. And I've been on that island for, a year now. And I pretty much was by myself. Jamie Dimon showed up early on. Some of the Bridgewater guys showed up pretty early on. But it's been, very quiet for a long, long time. And then all of a sudden, the crowds have shown up. Right. Recession Island, it's really been, the idea of high for longer has been pretty unpopular. Recession Island has been long a lot of bonds for a long, long time, expecting the economy to cool and expecting the Fed to cut rates. And those guys are all dead. That island is, disaster.
Well, it's dead for now, and it's not very popular, but we'll talk about whether that island, we should be moving there. But before we do that, let's stay on a little bit of the shorter term squiggles, and let's go back to Jimmy here. Jimmy, you traded in I guess you traded nat gas. It wasn't crude oil, but I'm assuming you watch crude oil a lot.
No, I traded both of them.
Oh, you did? Okay, you did. So you're both. So I'd love to kind of get your thoughts on what's going there. I saw Mark Fisher on CNBC, a guy that I really respect, think he's terrific. He on the rally, he was like, "Oh no, the next $5 is probably down," and then it proceeded to kind of rally up, surprise everyone. But now we're right back down, just like Mark said. What's your feel about what's going on there, and do you have any insights you'd like to share?
Well, I thought it was overcooked, and I had I actually had a decent sale target for this week. I don't want to jinx myself and brag or anything, but
by the way, it's not jinx, it's goocher is the correct word.
but then it came down really hard and almost blasted through where I thought it would, where there would be support. Gold did the same thing, and it kind of takes me back to Andy's thesis where all assets start just crumbling at this point in time. And so when I see gold and oil get smoked like that and get smoked right through decent support where I thought they would bounce, it gives me definitely pause. Holy shit, we might be in this next script where just everything starts getting smoked here, and oil's oil bounced today, but it didn't, there wasn't any, it wasn't everything kind of bounced, the back end of the yield curve bounced up a little bit. Equities made a crazy bounce, but everything else kind of just, didn't show me that the sell all assets isn't still on the table.
Right.
So that's that crude move was disturbing to me. It's holy shit.
But the crude move down, meaning was surprising and gives you pause.
No, I thought that I expected a sell off around 95.
Yeah.
Especially when everyone was oh yeah, we're going to 100. Then then I knew okay, we're going to probably come up short here. Yeah. But I didn't expect it to just go blasting through that 85, 84 area. You know what I mean? Yeah. That's that makes me oh, Jesus Christ. Or, what are we in here? You know what I mean? Is this different? Is this, and gold kind of made me feel the same way. When it started just ripping through decent support and stuff, it bounced today nicely, off an area, but it's still Jesus, are we in the middle of something here? Because right. I look at the back end of the yield curve too, 10s and 30s. Okay. They bounced today, 10s didn't take out Wednesday's lows, and, it fed into this short squeeze and stuff. But did they really clear anything technically that would give you pause that the trend has changed. They haven't like engulfed any old highs or anything like that. So I'm still in that, like, I know, the equity rally was whatever. It was impressive, but I'm still like in that, camp where I don't know.
June,
what we're
sorry, on
dealing with.
SEP 16, you put a chart of T-bonds and the long bond future, and you said it's rare to see a chart like this that doesn't end in a washout. Do you think we've had that washout? Or are you still...
Yeah, I do.
Oh, you do?
I think we've had that washout. I think we've seen a lot of the pain. I think the next test, like in that market, which and this is what like scares me about this, like the wild goose chase, false dawn bullshit, is like we could technically bounce back up to like those old October lows where everyone was calling a double bottom and all that bullshit, like we could bounce all the way up there technically as earnings are, and go on this like wild goose chase, when in reality, all of that would be like really negative to the inflation picture, I would think, like we're already like teetering on the line of like, are we killing inflation or is it coming back up? Or, you know what I mean? Is the economy weak enough to stamp this out? Now, if we go on this wild goose chase, then the answer is no. And it's only a matter of time before, we get the comeuppance.
Right. Okay. So Andy, let's go on to your higher for longer island. Let's talk about that. You mentioned how you were alone, and then Jamie Dimon, and he's definitely been on that island with you. I remember him talking about it the whole time. You say there's some guys at Bridgewater, and it seemed like it was the FOMC dots, which ironically, like, who cares about these stupid dots? But it seemed like that was the point where the market finally accepted the higher for longer. And we've had the 230s back up 60, a disinvert 65 basis points in a wicked bear steepening since then. Is that why you're now getting nervous about all assets?
Yeah, so I think the nervous about all assets came from the supply on 831. And that really is the dominant theme in everything I'm looking at.
Okay.
The twos thing, the Fed's close to done.
Right.
So when I look at the Fed and I say, are you going to change QT? Maybe they should, but they probably aren't. Okay. And now that the issuance is coming and Janet isn't just issuing bills, it's starting to have its effect, as you can see by the sell-off in the long-term bond market and the relative sell-off from the peak in the equity market. And so I think the Fed only had really, no one really expects much from the next hike or not. I mean, sure, maybe they will hike one more time, maybe they won't. And so, that's not much of a lever. So the only lever they could pull is the thing they've been saying for a long time, which is we're going to pause, and we're going to pause for a while before we start to cut. And, the 50 basis point, what they did is they changed the December. They left the December 23 dot the same, and they changed the December 24 dot up by 50 basis points. And that didn't actually have as much effect as you might think. You would have thought that the 2-year note would have been pushing 5.25 or 5.30. And, we're still around 5.07.
But isn't that because everyone still thinks the recession's coming so hard?
Right. They don't believe the Fed, Right. Before the SEP plot came out, there was 100 basis points of cuts priced into 2024. Right. And, I've been saying I came on to Higher for Longer Island when the number of cuts priced into 2024 was 160, and there was 75 basis points of cuts priced in for 2023. Now, of course, 2023, they ended up hiking, not cutting.
Right.
And 2024, it was 160 basis points of cuts. By the time the SEP came around, the Fed, the market finally had come over to Higher for Longer Island and had only priced 100 basis points of cuts in. Then the Fed moved the goalpost to 50 basis points. And so far, the market has still just not believed it. So they're pricing 80, 85 basis points of cuts still when the Fed's guiding them, which is less than the 15, the 100 that it was,
Right.
but the Fed's still guiding them lower and, fewer cuts, and the market's just not believing them. And yet the equity market totally believes them, says there's no recession.
But isn't the idea with the bond market is that the bond market realizes that no matter what the Fed says, if the shit hits the fan, either in the form of a bad recession or a market crisis, the Fed's going to cut. So, what's that line that the Fed decides when to raise rates and the market decides when the Fed's going to cut?
Sure,
So-
no, that's
so-
actually
so
what
just-
the bond market's saying, but the equity market's saying, don't bother me.
Right. But isn't that also one of the problems? And kind of, I have this theory that the fact that the bond folks were so sure about the recession, they were like on that recession island, and
100%.
they actually caused the long end to be trading at a yield that was way lower than it should have been. And that, in essence, almost contributed to financial conditions not tightening as much as they should have.
I think the demand side of the bond market is exactly what you just described. People willing to buy bonds, expecting the Fed to bail them out by cutting into a recession, and being fairly negative on the economy. And that trade has just been a miserable trade because It also typically means you're short equities or you're short credit or you're doing something in a riskier asset as well as being long bonds. And so that trade's just been a miserable trade, except during one brief shining moment in March of last year, of this year. And, then it looked like that trade was a home run. The Fed did, a relatively mild, firstly, the crisis was relatively mild. It was 3-4 banks. And then the Fed did a program that, basically said, we'll take care of minor non-systemic crises. And so, that really took a lot of the wind out of the sails of the guys buying bonds for recessions. And now that the supply comes on top of them, a lack of demand and a high supply, and you get 100 basis point back up in tens.
Right. Jimmy, coming back to you, one of the things I heard you mention is that you said, like, when everyone thinks one way, it's going to go the other way. Over the years, has that gotten easier to do?
It gets easier to identify those situations for sure. And I always, like, when I see them now, and I discount my experience. I'm like, oh wow, look how obvious, like, look what's happening here. And then I get a lot of questions on Twitter, on the DMs, whatever, and people, and I realize, like, that is a function of experience. Like people don't see it necessarily. So it is definitely a function of, like, experience. And
does it get easier to fade though? Like, because in essence, almost like, what's the old Jim Grant line? Making a good investment is have everyone agree with you about the value of it later.
It gets easier. It definitely gets easier to fade, because
it's almost like if too many people agree with you. Like, I'll tell you one thing, writing a letter, when people congratulate me and tell me what a great letter it is, those are the worst trades. And when everyone says, Kev, that's, I like you, you're a decent guy, but you know what, you're completely off the, wrong about this. Those are the ones I should double up on.
Right. And if you, like, most of my tweets are, like, come at really annoying times where I'm thinking that, and I'm trying to piss off as much of the populace as I can. No. Like when I said 4,200 is going to be great support after we blow through it. Like, that was when we were on the downside of it and everyone was super bearish and everyone was, like, I knew that night I was, like, I was going to be called everything, like, And the more they reaped shit on me that night, the more I thought, well, you know what? I think I might have something here, So that's from experience, and confidence, seeing these situations, like, it's a combination of both.
And here, I'll start with you. I'm going to ask you a question. Do you think that being in the pit and trading against people, like seeing people on the other side of your trade, and realizing that every trade needs another side and that person can be just as wrong as anyone else, has it helped you have the confidence?
Absolutely.
Right.
Absolutely. Are you kidding me? Like I mean, I was standing next to the guy that was taking the other side, and he was, a Wharton grad.
We won't
like
hold that against him.
I was, which would make me tremendously insecure, but he was literally touching me, that the motherfucker that I was taking the other side of, and we would argue, and go at it with each other. But that was instrumental. Absolutely. In
and
my
how about
process.
you, Andy? Like you grew up on the sell side of the desk. You realize that there's always someone on the other side of every trade. Like one of the things that kind of always shocks me is when people get in these huge arguments on Twitter and they're discussing, and I'm like, I have this line, I'll see you in the machine. At the end of the day, who cares what your opinion is? It's really only your P&L that matters. And I just welcome people being on the other side of my trade, because if everyone agreed with me, there wouldn't be a trade. And I think I view it as being on the sell side and realizing that there was people on every side of my trade. Do you view that the same way, like Andy?
Yeah, I mean, you take me back to 1987 when I was on the Brady Commission studying what happened during the crash. I've been, we got to see literally every single trade in the futures market and in the cash market with the customer and executing broker. And so it's amazing when you pair each of those trades up, how important flow and positioning is to markets. And, it's been a lifelong study for me to sort of really understand that. And the thing that always crystallizes it to me is when somebody says they are short, or there are, the market is long, or the market is short. Nope. Everybody's the same as they've always been. In aggregate, everybody owns what exists in securities in the market. And sure, somebody may be short, but everybody that's short has an offsetting long, so it nets to the same amount all the time. And so there is no they in markets.
I like that. You mentioned 1987. I've seen a lot of kind of analogies of how we're setting up the same way. In 1987, the stock market, was up 40% going into it. And then the stock and the bond market had some troubles. It had some wobbles. And next thing you know, the stock market crashed. And then finally the bonds went up because of that. Do you think there's any chance that we're going to experience an 87 type event?
So firstly, I'd say a 1987 type event where you fall 22% is essentially impossible now, given the way basically the things that were adopted from the Brady Commission, which includes circuit breakers and a closing of the markets at 20%.
Right. Okay.
So we're not going to get that big, but at the same time, there's interesting dynamics right now in the market, in that there's lots of portfolios that are fairly leveraged because of relatively low realized volatility in the last 6 to 9 months, and pretty good until just this last couple of months portfolio benefits from owning both stocks and bonds. And so, that's not working the last couple of months, but that leads to portfolios getting pretty levered up. And typically when, those portfolios are levered up, they know they have more risk, and so they buy puts. And that just really isn't happening anymore, given the pretty poor performance of portfolios during the 22 drawdown, where anybody with long dated puts saw, when the market went down, so did their puts, because vol fell as well.
Right.
And so it's
one question I have.
So what that's doing, let me just finish that thought. What that's doing is that's putting more people in the position of being long in an unprotected way. And when they do that, what they typically do is they do what they did in 1987, which is called portfolio insurance, in that when the market falls a little bit, they sell a little bit. When it falls a little bit more, they sell a little bit more. And when it comes back, they buy, and they keep buying as it rallies. And that's how they manage their risk. And you see that in a lot of the futures holdings of long-only asset managers, that, they act as if they are levering on the upside and delevering on the downside. And that's exactly the strategy that was employed in 1987. So beyond that, high interest rates, sure. high national debt, high trade deficit, all of the things, a high fiscal deficit, all of the things that were macroeconomically true in '87 were also true. But that's not my call. I think we drift lower versus sell off hard.
Jimmy, you had a question for Andy.
Yeah. So like 87, I have no recollection of I was doing bong hits in college during this. So everything I'm about to say is just read from books and looked at charts. But there, like in 87, it seemed like we came to an area like this in rates and in the market, and then like rates like made that next push higher, like from like 7 to 9 and into 10, and like equities rallied with them, like why? And I have no, like, during that moment, like why the fuck were equities rallying really hard as rates were pushing into this area? And could we see a similar situation like that just on a move, not a like a whatever in the near term future, where all of a sudden we get this like seasonal bullshit? Oh God, we're going to chase this rally in equities, and rates react, start going higher, and equities keep going higher into earnings bullshit, and the back end starts coming down. And that way we kind of like come closer to an 87 scenario. I don't know,
Yeah, that's an interesting point. So you're thinking we need another lift in equities with another sell-off in bonds before you get that type of flush. Yeah, that's totally reasonable. I think that the root cause of that type of action, where you have stocks up, bonds down, is generally when the economy, the NGDP of the economy is growing. And listen, we're ticking around 4% GDP growth that's gonna get announced, in a couple of weeks.
Why did people in 87, like, why were they reaching for equities? Can I
jump in
as
here?
The bond market was jumping.
Can I jump in here, Jimmy? Like, think about it. If you're down in your bonds, it's like an asset allocation shift. The money has to go somewhere, and it goes to some extent goes in the equities. And I think it's as stupid as one was going down, one was going up, which to me feels just like Mag 7 now. Like, why has Mag 7 taken a safety type, feel? Right. Like, and it just. I'm going to buy NVIDIA 35 times because I'm worried about the stock market. Right?
Right. Yeah.
I think it's that simple. What do you think, Andy?
Yeah, I do think that's the trigger. These things are priced fairly aggressively, and, they, unlike in past times where you've had things so concentrated, eventually you grow big enough. You are the economy, and you can't really grow much when you are the economy. The economy has to grow. And these companies represent 28% of the market cap of the S&P 500. And, they are the economy. So they really need this, wages and GDP growth to maintain their valuations. But you never know. You get a hype like you had from AI, along with the right conditions regarding, supply and demand of assets, like you were saying earlier about that bid for bonds that just kept everything levitated. And you can ignite something. I think the legs have got cut out with the bond market sell-off, so you don't get that coming back. And I don't know if, coming back up to 112 on 10-year notes or on 30-year notes, or 108 on 10-year notes is going to get you enough oomph to really ignite it. But if you get earnings are going to be super solid this month. The economy's strong, and so it's possible you could get another leg up in equities with a leg down in bonds, and that could set you up even more so to that 87 type thing. I believe that scenario.
Like, Jimmy, let's think about all the times you've seen like some big account just bully a market. And it's going to end badly, but they just keep buying it and buying it and buying it. And I think that's the part that a lot of people overestimate. They assume the market is more efficient than it is. I think it is efficient over the longer term, but there's lots of trades. Like you just know, you're sitting there and you're like, I don't know, like I can't give an example in a macro.
I got one. I mean, you can't look at the most recent move in oil and not notice a lot of people were long oil, short tech.
Yeah.
And that unwound. I mean, not today. Today was a different story and driven by different things. But all this week, you saw tech just not lose its bid when you saw the equity market sell off and oil sell off even harder. So, I think there was a big grossing that were going on.
Andy, I think that I noticed that. And there was 3 days, basically from the start of the month for the next 3 days, there was a huge sell commodity by Mag 7/tech. Yeah. And here in Canada, we saw stocks. I think it was even more than just like commodities. I think it was commodity countries because we saw lots of like blocks flying in Canada. Like I think it was huge, like sovereign wealth type fund, either adding to that trade or taking it off. But it was just, and it was very frantic. Like you, and I saw you on Twitter, you noticed the end of it and we felt it as well. There was a whole bunch of prints and stuff in Canada. And all of a sudden, everything lifted, and it really.
So that sort of thing can happen. Happens all the time. You saw it after the CPI, the hot CPIs for October in November 22. You obviously saw that a major hedge fund blow up in short-term rates during the SVB crisis. There's definitely been some fairly significant account shifting that has moved markets for a few days.
Well, and we've had times that, like I've sat on a sell side desk and, Fidelity's buying XYZ stock and they literally can keep the thing bid for a year and they just keep it bid and you'll be like, this is stupid. And eventually it's not going to work. But in the meantime, it's bid. And I feel like that's where we are on Mag 7. It's become just, as I said, it's become like a safety trade. It's going up because it's going up. People are hiding in it. It's the U.S. dollar is doing really well. But anyways, let's listen. I have another thing I wanted to hit here, and we talked a little bit about 87. Then we talked a little bit about vol. But Andy, you had a front seat, or at least a little birdie has told me you had a front seat for the big trade, which was after long-term capital, I believe.
It was later.
Was it later? But there was.
Yeah, I'll give you the history.
Okay, but it was a big vol bid on long-dated S&P 500 options. And so why don't you explain to us what happened there and how it all played out?
Yeah, I mean, if you bet, I've been an equity derivatives specialist for the first 18 years of my career before I started moving to macro. And, you go back briefly and you look at the big blow-ups in vol have always been because there is an insatiable demand for long-term call options on equities from an insurance companies offering annuity life insurance policies. And a long time ago, the Swiss banks blew up being short vol. And when they did that, they had to cover, and that's when Larry Hillebrand and the guys at Long-Term Capital took on $100 million of short Vega in 5 years.
So that means $100 million per 1% move in vol?
Yeah.
Okay.
So they shorted it. They shorted it. Everybody likes to short that sort of vol in the 20s because, it never realizes 20.
Right.
Ever. And they covered it during the unwind in the low 30s on average. I think they paid 42 for some stuff. And that was the long-term capital, one of the big long-term capital trades. And then the insurance company stuff kept going for a long time, and it wasn't quite as big anymore because you had the internet crash. And so equities came out of favor. And so they didn't sell as much insurance product. But by 2004 or 5, they started selling quite a bit. And long-term vol started getting bid again. And there really was no seller anymore because no one wanted to stand in front of what had taken out long-term capital and the Swiss banks before them. And then the financial crisis happened. And along comes Warren Buffett and says, hey, I'd like to sell some puts on the S&P 500 struck, here, which was quite low, as you remember. And everyone said, yeah, we need that vol. We're really shorted against these insurance products we've sold. How about you sell us some 10-year puts struck here? We won't require you to post any collateral, even though you're short puts. And Warren said, sure. And so he did $10-15 billion of notional, which was a quarter of $1 billion of Vega. So 2.5 times what long-term capital had done. But Warren figured, hey, I don't have collateral down. Markets go up over 10 years. I'm going to be fine.
Meanwhile, he's bad-mouthing derivatives the whole time.
Oh, yeah. Absolutely.
And he's got the biggest short book out there.
Yeah. And so he's just short naked puts, and markets start to rally. And then we hit the flash crash, which was also part of the European financial crisis, with Greece, being defaulting.
Yeah.
And the market fell 10%. And Warren said, you know what? I think I want to sell some of these puts, buy back some of these puts that I'm short.
Yeah.
And there was no offer. And, I looked at Warren's books throughout that time and know exactly what his notional was, because I was at Bridgewater. And Bridgewater was interested in what was going on, and I was responsible for volatility as an asset class. And I talked to Ray and Greg and Bob, the CIOs there, and said, we think, this is what's happening. Warren's trying to cover the demand from these insurance companies is increasing fairly exponentially as the markets are recovering, even though the flash crash was nothing basically in the grand scheme of things. I think there's going to be a fairly big squeeze, and I think we need to investigate it. And so I did. And at that point, 10-year vol. So Warren got Goldman short. Goldman started bidding it, and it bid it up to 38%. So that's 10-year implied volatility at 38%.
Jesus, that's so rich.
Yeah. It lasted, that bid was in the market from all summer of 2010. And I tried very hard to get Ray and Greg and Bob to sell that vol, but failed, which is a longer story, but not because they recognized it as a great trade, but they're more into systematically doing something they can do again and again and again. Anyway, turns out your pension fund up north ended up being the big seller.
Come on, really? They plugged it?
I swear to God.
Oh, I didn't know that.
And and they and so the interesting thing is, in doing the Bridgewater work, I looked at every single equity market since its existence, which was the 1780s in the UK, the 18 teens or 1820s in the US, whenever Buttonwood was, up to 1991 in Russia when equity started trading there, and looked at every single equity market and said, to see what realized volatility you're going to get if you look at every 10-year period in history of every equity market in the world. And it turns out the only way you realize 38 vol is if you go to war against the United States. So Japan, Germany, and Italy have had periods of 10 years where realized volatility, by the way, it was only 30. It was only above 38. It wasn't like it was 50.
Yeah.
It's just extremely rare.
For sure.
And so, you look back to, this was 2010, you look back to the period between 2010 and 2020, and the realized what turned out to be around, 15 or 16.
Wow. I know that trader, actually. He was a trader, and then he went on to be the CIO of Hoop. And he was always a little bit of a wild card. So it doesn't surprise me at all that he plugged that, but that's a big size that he hit it with.
Yeah. I think it only took about 80 million to knock the bid back down.
Wow.
That's pretty funny. All right, Jimmy, let's get a good story out of you. Last time you had one that you had saved for me. Have you saved any stories?
Well, you know what? I think the funniest type of story would be the fact that how Andy and I came together and how I absolutely fucking murdered my interview at Bridgewater at my first attempt to work with someone like Andy.
I didn't know you applied to Bridgewater.
No, you know what? I did. It was like around 2010. I sent my resume to them like as a cold call, and they came back to me and were like, "Yeah, come on in. Like, let's talk." And I thought that was like, not everyone got that, so that was like a big, I was excited,
right?
But I was also like a pit trader at the time, kind of a Neanderthal. You know what I mean? I hadn't really progressed past that. Like, like there's a difference between pit trading and then, like really experiencing all the markets and, moving past that mentality. I was tweening at that point. Yeah. I was still a little bit Neanderthalish, but I was like, oh my God, this is really cool. The biggest hedge fund in the world. I was so excited. And I prepared, like, I was like, oh, these guys are macro, like I prepared. And I had traded everything, I had traded energy and rates and equities, So like I like for like a month before this interview, you could have asked me anything about any fucking market, you know what I mean? Like I knew everything. I had done a deep dive. I had gone into a fugue state before this interview, And I had like given myself like plenty of time to get there, and I didn't want any stress about it. I knew they were like a little secretive, a little nutty, and I was a little bit intimidated going into that interview. And right away, I couldn't find the fucking place. It was like, this is before like smartphones and stuff where you could just like, hit the fuck, so I'm like, what the fuck? I had done like the Google Maps. I had like, prior to doing it, on my computer, but like the driveway was just like really like
off in the
fucking woods, man. So I passed the driveway like 85 times before I was like, wait, maybe this is it. Just go down this driveway.
And then it doesn't give it away for about, 500 yards.
Exactly. Now I'm driving 500 yards thinking, oh my God, now you're late, you idiot. You're driving down a fucking dirt road. Like, what are you doing? So by the time I got into the room to interview, I was like disheveled, and immediately they throw like this math test in front of me, and they're like, hey, do this. You got 15 minutes to do it, move on. Don't answer a question you don't know, whatever. Boom. And, so I'm already like disheveled about the lateness because and now boom, I take my jacket off. I have a math test. The math test is very difficult. And I have a time limit, and now I'm like starting to freak out because of the time limit and looking stupid, and you know what I mean? So like now math is almost impossible, or any of these questions are impossible because my mind is going at such a furious pace. So I try my best on it, but then the guys come in and I don't know if Andy actually went through any of this bullshit. I assume he didn't because he had pedigree and I was but then they the next, like the math test is over, fellas come in and I'm like, oh my God, thank God, like at least like I'm going to talk to humans now. And these guys were like, hey, we want you to debate, you have 5 different like areas. It was like, abortion, death penalty type of things,
Should it be legal to be able to donate your kidney for money?
Right. Like questions like that. And they're like,
both sides.
They're like, yeah, dude, check these out. You can argue either side, but we'll give you 5 minutes to think about it, and then let's go. And I'm like, oh fuck, like, God damn it.
Where's
like,
the macro questions?
Right, like, dude, you ask me a level about anything in the world right now. I can answer it. I can answer anything, but like, Jesus Christ, like, so I chose the death penalty. It was a complete fucking disaster. Like, and these guys wanted to debate for an hour. I figured, like, all right, we'll debate for 15 minutes, 20 minutes. Well, they'll see how I argue my points. But no, these guys were like, just sat there and just grinded me down. With like,
do you know what the purpose of that? So I never got one of those, but I administered a shitload of them.
Yeah.
Though Ray, by the way, Ray is interviewing with Ray directly is a lot worse.
Oh God.
Oh my God.
But let me tell you what the purpose of that interview was. The purpose was to see if you are assertive and open-minded at the same time, so that you can pick a side, determine that side, and then resist and defend that side until you agree that you should be on the other side. And then if you're capable of changing your mind, that's a win. So you win that interview, that interview technique, by well defending a point of view, sticking with it until it's time to switch, and then being able to switch. Okay. And that's a trading question.
Yeah.
Oh, that's interesting.
Yeah, and you know what? I could have totally murdered that in a trading situation if they had like brought that upon me. Like, I could have done that, but like,
right, but it's the same. They think it's the same thing, whether it is or not.
And you know what? In reality, the dude that I was arguing with, like, about the death penalty, he kind of like, he had some great points, and I acknowledged them. You know what I mean? He really
Which
was.
side did you take, Jimmy?
I took against the death penalty, and you know what? I took against the death penalty because I actually do believe in the death penalty. And I wanted, so I wanted to argue the counterpoint of what I actually believe in and hear their argument and like maybe mix things up a little bit. Yeah. And it did. But oh my God, this motherfucker though, he was so brutal, and like he just
it was probably Bob Elliott.
He
like Bob Elliott from like the new.
There was actually two of the dudes, so it was two of them versus me, but they were just like. They were just so methodical in their arguments.
They were like
and they were so patient. Yeah, they were like patient, methodical. They were Icemen in their arguments. So I like, you know what I mean? Like the emotional guinea in me. Like I had a hard time hanging in there. Although I do feel like I'm with Andy. Like I'm with you. Like if even about markets that I like feel very passionately about, like if you give me an argument, I'll argue with you, and like maybe you can change my mind. I'm not a complete douchebag where I'm like, no, this is it. I know because
I think that is an important part of trading, because so many people, they say an opinion and then they get stuck with it, and next thing they know, they've named they've named a drink after their theory, and they can't switch. Or something like that.
Right, then you're fucked.
Yeah, and
now you're all in.
Exactly.
And markets aren't all in. You have to be ready to wiggle.
Yeah, that's right. Ready to wiggle. I like that.
Right.
Okay. Let's talk a little bit about what you see. You have this thing that you posted, which I think is absolutely terrific. It's called the Damp Spring Report. It is the shifts in growth, inflation, risk premium, and positioning all lead to opportunities in the markets. And it's kind of your playbook, and it has the different acts. And why don't you just tell us what act you think we're at now, and where the next, what act we should be looking for that'll be coming up?
Yeah, so this is something I wrote on July 10th. I called that whole product is called the Damp Spring Report, and that particular episode was the script. And it's the script to end inflation, and it really is a set of how you get from too much inflation to too little in an environment where a credit crisis is not likely to occur. And the first part of that script is higher for longer. And that was what we had been seeing for since they started hiking. And by July, I realized that, and we just spoke about this, Kevin, regarding the demand for bonds from these the recessionistas, and the lack of supply. And by July, I realized we needed a supply catalyst to get to a point where you can take the next step. And so let me lay out the steps. In Act 2, bond markets finally bear steepen. And the bear steepening is what takes bond prices down, which takes some of the juice out of equity prices. And you begin to have the wealth effect hitting supply, hitting demand for goods and services. And so I think Act 2 ended, it might actually have been today. I called it ending Friday. Who knows when it ends exactly? That's not the point. The next act is, and the reason why it ends is because that 90 basis point increase in long-term bond yields is the bear steepening. Now, is it over? It's close if it's not over already. So the next step is that now bonds actually look pretty cheap to cash, and where they haven't for a long time. And they look actually pretty cheap to equities, right, which they have for a long time look very cheap to equities. But that's partly because equities earnings have just been growing gangbusters, and that's kept the bid in equities and caused them to diverge from bonds. And so Act 3, which is where we're in now, is when that big sell-off in bonds starts creating flows out of equities into bonds. And I think we're in that stage. And what that will look like is bond prices meander. Maybe they drift lower, but basically meander. And equity prices correct 5, 6, 7%. And I think we're in the midst of that. Obviously not today, but all last week we were. And I think that ends up sort of, if we get through earnings, which are always going to create the sort of wiggles that Jimmy and I were just talking about, you never know what's going to come out of earnings. But if you get through earnings, you run into another supply catalyst data point at the end of, right around Halloween, and another Fed meeting, which, after today, there's a better chance that they're going to hike. And that takes, and maybe there's a bit of seasonality bids for stocks that gets juicy. And that's sort of the next phase of that, is to take the wind out of the sword, the sail of equities, and drive them below the 4,200 level that Jimmy was talking about. My view is to catch up to the 5% bond yields. You're going to talk about 3,900 or 4,000, and that's Act 3. And then Act 4. Now people are less wealthy. Christmas sucks. Can't buy the G.I. Joe doll with a kung fu grip, and
you're showing your age.
I know. It's amazing how few people actually have watched that movie that are listening to this. It's a disaster. It's the greatest trading movie of all time. Anyway, and when that happens, you lose out on the wealth effect, and that starts hurting demand, which starts taking some of the extremely aggressive earnings expectations for 2024 down. And that is Act 4, where equities actually start falling, not because of multiple contraction, but because of actual earnings expectations dropping. That compounds because that leads to firings, and that's how you get the unemployment rate up, and that's how you get the economy slowing. And I think that's I'd like to think it's not going to happen, that we're not going to be in Act 4 in this earnings cycle. I think earnings are going to be great. But by February, when late January, early February, when all those earnings and the 2023 earnings for the year come around, at that point, you might see this Act 4 start playing out. And that's how you end up in Recession Island, because you start losing jobs. That creates lower demand, which creates lower stock prices, which creates lower interest rates, which ultimately slows the economy, is now slowing so rapidly that the Fed has to intervene. And sort of that's the script.
That's good. It's great. I love it. And okay, so you know what? We're going to do some questions now. And actually, I'm going to ad lib one here. Andy just said that the Trading Places is the greatest trading movie that's ever been, and I don't disagree. It's right up there. Jimmy, tell us your favorite, and if it's Trading Places, you have to tell us your second favorite.
Trading Places is amazing, but I also like Ferris Bueller's Day Off, where they show
The Pit,
the scenes of the Chicago floors.
Okay.
Because you know what, I knew some of the guys that were actually in that video, and they were kind of like floor legends after that, but those were real people. So I kind of like just the scenery.
Okay, I got it.
Okay, but for the trading a crewman,
right.
For sure. The other.
I'm going to give you some questions here. Let's start with a couple serious ones. We'll get those out of the way, and then we'll do the fun ones. So first of all, Don Cox used to say that you shouldn't invest on what is page 1 today, but what's on page 16 on the way to page 1 tomorrow. Do you have any trades that would give us the Don Cox seal of approval? Either one of you can answer.
I'm going to let Andy take this.
Okay. So the one I thought about, so I think that's generally true, that by the time it's on page 1, probably before that, when Kramer's talking about it, it's probably too late. It's fully priced into markets. And so you have to be able to anticipate what's going to be on page 1. Now, that doesn't necessarily mean it's on page 16, but you have to anticipate what's going to be on page 1 and know what's priced today, so that you can figure out when it is page 1, you're exiting instead of entering. And so the one thing that I've been thinking about, and that's mostly because of the oil sell-off, is the Aramco. So Aramco is trying to float an additional secondary offering, and I wouldn't be surprised if you get I don't know if it's a dead cat bounce or a rip to new highs, but I wouldn't be surprised if oil gets a pump into that IPO, and that's sort of a few weeks to a few months off.
Okay. So they jigger oil higher to help float their IPO.
Plus, I would add there's geopolitical aspects to that too.
The Israel thing.
Yeah, a lot of things. Like if even the Russian situation right now. You want to put pressure on this administration. Jack up oil. The jack up inflation prints. There's geopolitical aspects to it.
Oh, 100%. I think oil is one of the most geopolitical commodities out there.
Sure.
Right.
Yeah.
And this could affect the election.
Oh,
they always, Russia intervention. Well, this could be an aspect.
Well,
I think the interesting way to play that is gasoline, because that's led us, gasoline falling led oil down big time. And it'd be interesting to look at the crack spread to see whether gasoline is the way to play it versus crude.
All right. Byron Ween used to talk about his top surprises for the next year. He defined a surprise as something the market has signed a less than 1/3 chance of happening, but he thinks is better than 50-50. Do one of you have a Byron Ween surprise for us?
Sure. US dollar, even though we remain in higher for longer with no imminent recession, trades well below 100 on Dixie.
Wow. And what do you think? What's the reasoning behind that?
So a combination of a country that is massively increasing the amount of money in the system through fiscal, and relative strength in some of the other economies that are anticipated to be extremely weak based on pretty much everything you look at, in particular Europe, the UK, Japan, and China.
Got it. Okay, so now let's get to a little bit more fun ones, and they'll progressively, hopefully, get more fun. We'll start with, what part of your daily process are you amazed more people don't do? Jimmy, let's start with you there.
My daily process is really disturbing, actually. I have OCD. I have all sorts of issues. So I'm running through chart progressions and doing all sorts of weird shit all day long that I don't really, I wouldn't think anyone does other than me, or I wouldn't advise doing it because you'll go fucking insane. So I'm me, whatever. I have issues. But you know what? In the same respect, my fucked up issues is probably, it's probably why I keep my thumb on the pulse of the market, because it is disturbing. If someone stood behind me and watched me during the day and watched me go through my charts, like boom, 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 back and forth, like they'd be like, "Holy fuck!"
So is that how you get
issues.
a feel of the market? You just go through piles and piles, and are they dailies or are they 15s, 5s?
Everything. It's everything in every market. That's the problem. You know what I mean? Like I need to look at every time frame on every market and every, so it's like a constant, like boom, 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 like, and then going back to the beginning and then going through it again and then going back to the beginning, so it's like a constant sweep of all these time frames, all these levels, all these different markets that give me this, like, feel for it. But it's not for everyone, like,
I got it though. It's the way. It's the way
I'm an uncomfortable person to be around in real life when I'm not looking at this shit. So it's
Got it. How about you, Andy? What part of your daily process are you surprised more people don't do?
Two things. One, the first thing I do when I have as I'm having my coffee, is turn on my brain by playing Wordle.
Okay.
And then I play far more Pokemon Go than the average 59-year-old person, or possibly the average person on Earth.
Wait, what?
Pretty much all day.
What is Pokemon Go? I don't get it either. What's the concept behind that?
It's on your phone. It's something where you have a real life map of real life, and you go out, and on that map are these stupid Pokemon.
Yeah, like they're made up, but they're in specific things. You got to go find them, right?
Yeah,
like there might be one in your house. There might be one in your house, Jimmy. You don't know.
There's a bunch of them. I'm sure there's some around Jimmy's house.
Jimmy, get on that, buddy.
Got to catch them all.
Okay, here's the next question. If you could pick one trader or investor to go drinking with, and you can't already know them, who would you choose and why? Jimmy.
Wow.
Can't already know them.
Yeah, it's got to be someone. If you want to think about it, Andy, do you have one? Come on, anyone. Like, you want to go drinking with Warren?
Well, I don't want to say something too quickly.
That's fine. Well, you know what?
I would like to talk to one of the ledges, you know what I mean? Especially one of the contrarian ledges.
So what does that mean? One of the ledges.
And this is not necessarily saying they're the same. They're that now, because most of these guys are like Druck or something. Right. Like a guy that pissed against the wind at times, and you
got to pick one though.
Talk.
Is it Druck?
Maybe it's Druck. I don't know.
I think that'd be mine too.
Yeah,
Druck or Soros.
He seems real. And he seems
like a great guy.
Right.
Yeah.
It certainly wouldn't be, Jeff or,
Come on, in Buffalo?
I mean, there's certain guys that retain that quality, of humility, even no matter how much they're successful or kill the markets. And Druck is that type of guy.
Yeah.
Jeff isn't. Jeff is gather around. Listen, everyone gather around. I'm about to speak. You know what I mean? And that type of shit doesn't wash with me.
I'm with you. Druck will say it all the time. He'll say I could be wrong. I probably will be wrong.
Right.
He's very humble.
Dig that.
And one of the things that I always say is that if you go look, and I think Druckenmiller talks about it, he says, I'm right 60% of my time, which means 40% of the time I'm wrong. So if Druck is right 60% of the time, what hope do schmucks like me have? So it really reinforces that you're going to be wrong. It's how you deal with those not mistakes, how you deal with those being wrong moments is really what differentiates you. So Andy, who's your guy?
Yeah, so I talked to him on the phone once, but I'm going to say his name anyway, and that's Jim Simons.
Oh,
wow.
Yeah. That's a good choice.
You talked to him on the phone?
Yeah, once.
Yeah, that's a good choice. So why? Tell me what would you ask him?
Well, I mean, I'm presuming I'll get some honesty and some openness.
Right, you're going drinking with him.
Highly unlikely.
No, but let's just imagine he's going drinking. He's promised you like the, you know.
By the way, I would have said Jim Simons too if I would have thought he would have accepted my call.
Yeah.
You know.
But you're allowed to choose whoever you want. Oh, what right. Jimmy? Druck's going to accept your call, but Jimmy's not. Jim Simons is not.
Yeah, you're right. Neither of those motherfuckers are accepting my call. But go ahead. Sorry, Andy.
No, I guess I'd ask him. Where do you think the next alpha is?
Okay.
Because I don't want to hear about how he has made his money, because, you know,
that's good.
That's not really that useful. It's where he's thinking about, now he's retired, but where he's thinking about there being alpha in the future.
Right.
That's a good one. Okay, so here's we're gonna say, and I'm gonna start with Andy because I've been putting Jimmy on the spot first. So this time I'm gonna start with Andy. Name one thing about the other guy, meaning your partner's trading style, that you admire because you aren't as good at it.
Definitely market feel.
Okay, I could see that. How about you, Jimmy? What do you like about Andy's style that you're not as good at?
Well, you know what? Like, one of the biggest things, like when Andy called the QRA announcement back in, like, I think it was August 2nd. Like, I would have been completely blindsided by that bullshit. You know, that would have not been on my radar. It would have taken me 3 days to figure out what the fuck just happened. And, you know, so he's like, his genius in that respect is like I know how to drive. I just don't know where the road is sometimes. And he always knows where the road is.
That's good.
And that helps me, man, a lot.
Okay. So back in July, Andy tweeted the following. I'm going to quote his tweet. Okay, so was at a club in New York City that was in the basement of a building just off Madison on 61st or 62nd. In the late 80s or 90s. Super posh relative to my typical mega clubs. Lots of Spence girls. Now, don't say anything. At which point, Jimmy replied, "What's a Spence girl?" Okay. Which just had me fucking like laughing in hysterics. And then I had to tweet back to you. I said that you two pairing up made me realize that it would be the greatest sitcom comedy of ever. It would be Wall Street elite meets Chicago pit trader. As their worlds collide, chaos and hilarity ensue. Okay, that's what's like,
dude. I'm telling you, it really is similar to that. Yeah, like, you know what I mean?
For
like,
sure. Jimmy had no idea what a Spence girl was.
I don't. I
got to tell you, Jimmy is Felix.
Okay, so now I'm going to ask you something. Forget about looks. You're not going to pick somebody on looks. You're going to pick an actor based upon their acting ability and their personality. Who do you want to play yourself in the sitcom? Andy, I'm going to start with you.
Oof. In the sitcom.
And Jimmy, if you're ready, you can give me yours.
You know, I'm going to just say, because though he's a little older than me, I'm going to say Larry David.
Okay. Larry David's nice. A good choice. Okay.
That's awesome.
Jimmy, who do you want to play you?
You know, like someone asked me that like before, and this is like an obscure actor. I don't know. Like someone that's fucked up, you know, like I always thought like this, no one knows this actor, this guy, Emil Hirsch.
Emil Hirsch. You know? I'm going to Google this. Let's have a look.
But he's edgy.
Okay.
And he's edgy in real life. You never know. Like he's a guy you don't even want to like invite to a pre-screening and a promotion of the movie he was in, because he might fuck it up, you know, like, so I kind of feel like I'm that guy.
I hear you.
You know, like I'm there, but I'm also a little bit, you know.
I kind of think maybe Michael Madsen for you, like a Mr. Blonde.
Oh, that would be huge, dude. That's a huge.
Yeah, he's a little too.
I wouldn't say Michael Madsen for myself, just because I wouldn't want to be a douchebag and be like Michael. You know, like you say Michael Madsen for yourself, you're probably a dickhead.
Plus,
I mean, like,
plus Mr. Blonde already has it. Mr. Blonde already has him.
Right. Yeah, you know, like either it's going to be a troublemaker or a goofy bastard.
Okay.
You know, like
let's go to the next question here. Let me grab this one. Oh, if I told you that I could reveal to you one economic indicator 6 months from now, And it has to be an economic indicator. You can't tell me the value of the dollar or the price of an interest rate. It only has to be an economic indicator like inflation or unemployment, whatever you want. Which indicator would it be and why? Andy.
The unemployment rate.
You would, eh? You think that's that important?
More than inflation by a long shot.
How about you, Jimmy?
I would agree. And you know what? I really don't give a fuck about indicators. I care about how the market reacts to them, right. So like if you could give me, I've had like numbers given to me prior to the number in an illegal fashion, and I've still fucked that up. So you tell me,
no, and
give me an indicator.
I completely get that, Jimmy, because like we've laughed and sat on the desk and go, even if you told me the number, I wouldn't know what to do with it.
Yeah, it's ridiculous.
Yeah.
Right.
The alpha and being able to predict numbers isn't worth anything.
Yeah.
No, but I do agree with Andy though. Like employment right now is sticky.
Right.
You know what I mean? Like without that like backing off, you can forget about.
Yeah, I mean, if we're below 4% employment 6 months from now, bonds are lower, stocks are higher, pretty much for sure.
Yeah. I hear you. To me, it's either inflation or the unemployment, but I hear you why you choose unemployment. Okay, so here we're going to finish up with the question from our previous guest, and our previous guest was Warren Pies from 314 Research, and he had the following question.
My question for the next guest: if you weren't doing what you're doing, and this, assuming that you're in this business, then what career path would you have followed?
So, Andy, if you hadn't been a trader / portfolio manager, investor, what would you have done?
I'd be a doctor.
Really?
Uh-huh.
What would be your specialty?
So my hands shake a little bit, so I don't think I'd be a surgeon, but probably some sort of puzzle figure outer.
Okay.
I relate to Dr. not the drug habit, but I relate to Dr. House on the TV show.
Okay, got it. How about you, Jimmy?
First of all, I'd like to say that he could be a doctor. He would be a fucking great doctor. You know what I mean? You meet dudes in your life where you're like, wow, you could have been a doctor. Like Andy could have breezed through the reading, the memorization. He could have been a doctor fucking easy. And you don't meet many people like that, but he could have done it and he would have been a great doctor. Me, on the other hand, I had limited choices. I wasn't going to be a doctor. I would have been, you know what? If I didn't do this, I would have been right now. I would be in the DEA or the FBI.
Oh,
I'd probably be in the DEA. My father was an FBI agent. I went through all like the interview process with the DEA. I was like right at the doorstep prior to this, but like for me, it would be more about an adrenaline thing. You know what I mean? Like I was gonna go into something that like,
yeah. Would you have gone undercover?
Fuck yeah. Fuck yeah. And you know what? Yeah, I tell you, one of the, a little side story about my DEA interview. Yeah. I had to do it. My dad had like connections because he was in the FBI. We meet down in Miami. I go into this, I have lunch with my father and like the top DEA guys. And they're like, you really want to do this? We're ready. Like you're Dave's son. All right. And like, we're having this real conversation. And they're like, listen, the only thing we need to talk to you about is like, what drugs have you done personally? And we want you to like be completely honest because this is before we hook you up to a lie detector and we're going to ask you these questions again, because they do that, so I was like, all right, and I had to like say this shit in front of my father.
Oh God.
And it was really uncomfortable. They didn't have any problems with anything that I explored. They were like, that's cool. Like you're in college, shit happens, whatever. We don't, we don't need a teetotaler in here in the, administration, But, you know, and my father is like, I can just see him over in the corner rolling his head going, Jesus fucking Christ. You know, it was brutal. It was fucking brutal. The one thing that like really pissed him off was that I had done mushrooms.
Why mushrooms? Why mushrooms?
Yeah,
Why would mushrooms piss him off? I would have thought something.
He was like, mushrooms? What the like? He had never like he was old school. Like he was like he would have rather heard me say acid and blow. You know what I mean? Like he was like, what? He's like, what are you talking about? Mushrooms? Like he hadn't even heard of them. And when I described them to him, that just made it worse. You know, like yeah. You know, so it was all around. It was an uncomfortable situation, but that's where I would have been. I would have gone that route. Okay, you know, for sure.
That is hilarious. All right, which one of you guys came up with a question for our next guest?
I got a good one. So my friend Victor Hagani, who was at Solomon with me and then worked at Long Term Capital in a senior position, partner, and then since then has really focused his entire life on beta. Just wrote a book called, what was it called? Missing Billionaires. Anyway, Victor asked me a question about 2 years ago, and he said, if I offered you a certain real interest rate for life, how high would it have to be for you to no longer try to outperform the market?
That's a great question,
isn't it?
So that's my
killer
question.
one.
Yeah,
I love it. I don't even know the answer, but
yeah,
that's a great question.
That is a great question. You know, offline, you'll have to tell me your answer. I don't want you to ruin it, and because we'll have to save it, but you'll have to tell me the offline. Listen, it's been great having you guys on. Why doesn't one of you or both of you give people the kind of spiel about your whole firm, where they can find you, how it works, where they can sign up?
Sure. So it's all Damp Spring, DAMPED Spring. You follow me on Twitter. If you're interested in hearing more from Jimmy and I, we have a subscriber service called Damp Spring DS Read, which you can find out details on dampspring.com. It's an interesting product because Jimmy and I talk like this to our clients, a little bit more focused on markets every Sunday night for 45 minutes. And then throughout the day in our private Twitter room and our Discord room. And you also have access to the trades I do for my own institutional portfolio and the trades and research I give to, some of the biggest macro hedge funds in the world. One of which was that script you just mentioned, at exactly the same time that these firms get it.
Got it. So why don't you tell people also, if they want to follow you specifically on Twitter or X, whatever the hell it's called, what your two handles are there as well?
Yeah, mine's Damp Spring.
Okay. And how about you, Jimmy?
Jimmy Jude 13.
Jimmy Jude 13. And Jimmy, are we going to get a book, buddy?
Dude, you know what? I actually need Andy to read the book first and give me the go ahead. Because it's
declare it with compliance.
I need to because it's a little edgy and
Okay. Well, maybe it'll be your retirement. When you retire, you'll finally publish it after the fact.
I tell you what, I'll send you it personally so you can read it.
Okay, sounds good. I'm always keen. Listen,
it's because it's done.
Oh, well, I'd love to read it. Anyways, listen, It's been great having both of you on. I really appreciate you for your time. And, people, you should go check it out. And if you want to hear more from Jimmy and Andy, the unlikely duo played by Larry David and Matt. What is the Madsen? What's his first name? James Madsen.
Michael
Madsen. That's it. I got it. Anyways, coming soon to a show near you. Take care.
Thank you so much for having us on, Kevin. Again,
thanks.
Appreciate it.
Take care. Bye-bye. All right, Patrick. Time for talking charts. It's going to be a good one.
It's going to be a good one. All right, let's talk about it. But first, let's talk top three things we were watching 2 weeks ago. We were talking about did another leg lower start in the bonds? That was a yes. Inflation, we'll talk about that in a second. And then, of course, the job numbers, which came in hot. What did you take away from this?
Yeah. The job numbers were outstanding in terms of how strong they were.
Unbelievable.
But what's even more interesting is the reaction. Obviously, we'll talk about that.
Yeah, but do you think that this is just like a 1 month anomaly, or do you think that this is actually a new trend?
Well, I wouldn't call it a new trend because the job numbers have consistently been hot. One of the interesting things, though, is that although the numbers are coming in hot and then they keep getting revised downward.
Right.
So the conspiracy theorists are actually wondering if that's on purpose to make things look better than they actually are. But, I was talking to Cuppy about this earlier today, and he's like, he keeps saying that the problem is that New York and San Francisco, they're experiencing, let's just say, a recession / slowdown. And everyone that's trading lives in, or a lot of them live in those two cities or managing money. And so they think it looks so terrible. But when you go to the rest of the world, the rest of America, things are hot. It's just, he keeps talking about Joe. He says that, they're selling houses like unbelievable. And it's tough to find people to work. So it's kind of a dichotomy. And the one thing I don't get, Patrick,
I don't get it.
Is that everyone is looking for the U.S. economy to roll over. And I still cling to my idea that the U.S. economy will be the last to do
absolutely.
that.
Like you've said it in the last episode where Canada will roll first, look,
I think the rest of the world will roll first.
But Germany already rolled.
America to lead.
But Europe's already rolled.
Well, I agree, but I'm saying if you're expecting a big upturn in unemployment, I think it's going to come first in Europe or in Canada or Australia. You'll see it there first before you see it in America.
All right. So let's talk about top 3 things to watch over the next 2 weeks. Number 3, Kevin, the U.S. dollar.
Oh, gosh.
I had to get it in there. Come on.
It is important.
It is important.
It is important.
It is important.
Yeah.
Okay, let's just quickly put it on a chart here. The bottom line is we broke out to 2023 highs. And to be honest, by the technical techniques I use, this move is pretty much mature. It's long overdue for a pullback. And we started getting one, this little pop and drop. We'll talk about it a little bit more once we get through the top 3. We could easily see a couple dollar pullback. The question is it just a correction from a short-term overbought state that will be bought on dip, or have we seen a meaningful swing high in here? And that's actually why I think it's a top 3 thing, because I feel that the dollar strength has actually been the thing that's been really pressuring risk assets. And if the dollar pauses for even a month or two, that could be like, someone was stepping on your chest, not preventing you from breathing, and then you suddenly have the ability to take a breath. Like the market could just reflexively snap back. You like that analogy?
I like that. That's a good analogy.
Right? And so
the U.S. dollar is like someone stepping on your chest.
It's not easy to breathe. It's not easy to breathe. No, but the question is, if the dollar goes through a multi-week or a 1 or 2 month correction, which it doesn't have to be a change of trend, just simply an overbought condition that's consolidating, it might be enough to allow risk assets to move the other way for a little bit. So that's number 3. Number 2, the start of the earnings season. It really, the pig in the python moment is all the way at the tail end of October, but this is where we start seeing these companies come out with Q3 earnings, and that's going to be important because in my mind, obviously the jobs numbers look like they're hot, but I think what these companies say and the guidances they give will actually be an important tell as to how a potential economic slowdown would look, or whether it's much more in the future. What's your thought on that?
Well, I actually do think it's interesting because if you look at the kind of blended 12-month forward EPS, you'll see that it's been creeping higher over the last 3 months. And it'll be interesting to see if we get a situation where earnings do disappoint, and not just the price action of the stocks after the earnings come out, but the actual earnings.
Yeah.
Then it'll kind of be interesting to see if there's a repricing of the stock market lower, based solely on kind of them anticipating better earnings earlier, meaning that they have to take those back. I don't know though. I kind of think just like the jobs numbers, that the earnings might not be as bad as kind of weak as people or the bears are expecting?
Well, irrespective, it is one of the top 3 things to watch, and,
For sure.
and it's going to be,
For
and
sure.
it'll be really interesting to see how the market reacts to it. And number one, the CPI and PPI numbers are coming out next week, and obviously these inflation numbers, like obviously with hot jobs numbers, if inflation stays a little bit hot, suddenly you have to think that November meeting, a rate hike suddenly could be more seriously considered. Like, I mean,
Well, I'm actually surprised that the November isn't being fully priced in already. To me, it's pretty clear that the Fed has signaled that they are on, they continue to be on a stance of one meeting or one hike every second meeting, my kind of what I call 12.5 beeps raise. And we paused the last meeting. We're due for a hike this time. We had for a while priced it out because it looked like the government was going to shut down. Once the government shut down, I thought to myself, okay, now the chances of November go up greatly. And with
But
this
you know what? The,
unemployment number, it just seems to me that it's a bit locked in. The only thing to me that
But
saves
listen,
it,
the CME Fed watch tool, looking at the futures, is still giving a 73% chance of unchanged and only a 26%.
No, I agree. I'm not disagreeing with you. I'm saying I'm confused as why the market is not fully pricing it in. It seems pretty clear to me that the Fed has indicated that. And absent, I think even with a benign inflation number, I think they go.
Really? That's going to be.
I think.
Well,
I think
if you know what, that's interesting because rarely does the Fed do something that hasn't been priced in advance. I mean, it happens, but it's not often.
No, it almost never happens. But what does happen, Patrick, is that the market reprices in the week going into.
Well, this is why it's going to be really important to see. I think this inflation number is going to be a big tell because, I mean, we're going to be basically next week in the middle of October, and if that numbers come in hot with these jobs numbers, that November 1st meeting won't have the privilege of seeing the jobs numbers in November. Well, I'm sure they have the information anyway.
No, I don't think that they have those that early.
Yeah.
And I don't think that.
Well, they might have indications, but that I don't still
they
don't.
Might, no, but
I still think that.
But I guess what I'm saying is even with a benign inflation number, I think they're still going. The employment was what they were worried about. If employment,
I think that's crazy. The fact that you're saying that, like well, listen,
if the market for some reason the market's not looking like it's going to crash, but let's just say it did, then I would take it off the table. Or if inflation end up surprising way to the downside, but let's just assume that neither of those happen and it's just status quo. In a status quo environment, like just whatever inflation, somewhat in line, and the market not collapsing, I think the Fed tightens again. They told you 12 out of the 17 or whatever, 12 out of the 19 FOMC board members said they're going to tighten, once more before the end of the year. I think that they'll do it in November as opposed to December. December, the government could be shut down again, and then they're stuck with the same problem. Yeah. And I still think they're on this 12.5 beeps a meeting. Yeah. He tells you a million times. I think it's happening.
All right. Let's talk some charts, Kev. All right. S&P 500. What a drop and pop. And
you think?
No, but I think it's important because this 4250 area. So, okay, as bearish as this drop felt, right? Let's kind of step back and reflect on this. This was a 400 point S&P drop, 8.66% from peak to trough over the course of 2 months, right? And so we have this 2-month pullback that basically did a 50% retracement of an 800-point rally from March till July. There was no crash day. There was no puke day. There was no vol spike day. This actually has all of the characteristics of a systematic mean reverting correction rather than the next leg of a bear market. Now, it could have turned into a crash, and I was certainly not taking it off the table, but there is no bigger tell that when you have some news that pops the dollar, like a strong jobs number that causes a 30, 40, 50 S&P point drop within minutes, suddenly reverse and be green on the day, at a point where you're exactly at the 50% retracement after selling for 3-4 weeks straight, it could be a turn.
Yeah, listen.
It could be a turn.
I watched this great piece with Carter Worth, who's my second favorite technician after you, Patrick.
Oh, thank you.
And he loves the 120-day moving average. Can you pop that in there?
Mm-mm.
You can't?
Too much work. I'm sure it's there. We believe you.
Anyways, it popped right. I mean, it coincided with that, and then the trend line. He drew the trend line, and it just seemed to be like if you go back and you draw the trend line.
The point is, my thesis, actually going back to July and August, was that much of the second half of the year, it had a very good chance of being a bigger topping formation with many fake outs, more than it did of a big kind of V top and then a big crash on the other side. And I think maybe what everyone is realizing is that shit ain't gonna hit the fan all at once here. And when you have such an oversold market, us rallying back to 44 or 4,500 in a counter trend, mean reverting kind of pop higher that basically suckers buyers back into the market just to take them through the rinse cycle all over again is a very typical behavior in a bigger topping formation. I would say even if the market rallied here, I would say with a pretty high degree of confidence that the high of the year is already in. We're not clearing 4,600 by the year end. I mean, there's only a couple months left, but I don't think we're going to make new highs in this calendar year. So to me, any rally here has a chance of just being faded at some point, but we're oversold. Like here, like Kev, look at this. This is the percentage of stocks trading above their 50-day moving averages. We've got 17%. Look in the 2022 year, every single swing low of the bear market came in under 20%, reversed and swung the other way. That didn't make it some new bull or bear market, but that's the overbought and oversold cycles that happen. And we're pretty oversold at this moment in the market. And if a market isn't going to crash in the middle of an oversold state, then on balance of probabilities, it's going to unwind the very oversold state with a rally.
Got it. I'm not disagreeing with you.
Now, with that said, I'm not getting bullish. I don't think that this rally will stick, but it will squeeze all the shorts out. Like when you have 100 to 200 S&P point rip that lasts for multiple weeks, the bucket puking that happens from everyone that piled in short too heavily, they're going to all get cleaned out of their shorts, and all the CTAs will get flipped back long and all this stuff, and it's going to be just a rinse cycle in a very typical topping formation whipsaw kind of price action. I don't think we even clear the September high on the rally, but I think we can definitely bounce here. This kind of intraday reversal, I think you can't ignore it. I think it's the sell-off is now much more of a 2024 story. The likelihood it happens this calendar year is diminishing unless there's a big earnings surprise. Do you want to add anything, or can we go on?
No, we can go on, buddy.
All right. So second thing, the dollar. We talked about it earlier. Look, after such an advance where we basically had this 12-week, multi-month advance relentlessly without the rally ever being checked, it's due for a pause. Now, what you can see on the dollar index, all of these previous highs that happened in this 104 to 105 level right in here. And typically, a mean reverting correction will find support on what was previously overhead resistance. So us having a 2-point Dixie pullback here, where over several weeks we get back down below 105, would actually be within the normal characteristics of what you would see and the behavior of the way markets move. And that could be what actually allows many risk assets to actually rally for the next several weeks. Again, that wouldn't be a short sell in my mind unless you're a day trader where you're trying to clip 100 pips on the downside or something. But other than that, I would just view that as a future buy on dip if the dollar gave you that kind of a pullback. Is there a particular currency pair you want to touch on other than the yen? We're not touching that one?
No, I don't.
Because the euro could easily bounce to 107, 108. That pound sterling after that bloodbath could easily get back to 124, 125. And so you have definitely these oversold conditions, and if it ain't going to crash, it's going to mean revert. And this is definitely the jobs number. It looks like, it feels like this could have been the swing day. Usually like some news catalyst like that does it. Look at the way gold is putting in a reversal candle off that low at the same time. Like gold is overdue for a bounce back to 1900. Again, that doesn't make me yet bullish on gold again, but it's been a 3-week bloodbath, right? Like this, the gold bulls have just got their asses handed to them, and right now it's very oversold. And if again risk assets work and the dollar's pulling back, I don't see how like gold going back to 1900 would be par for the course. The only thing is that make it a buy? I don't think so. I think that the bigger buying opportunity in gold is maybe December, January, when gold gets to 1900. Probably will go retest the lows, and so it's again just a day trade to the upside, and the bigger buying opportunities later in the year.
Got it. Okay, what else are you looking at?
Crude oil. What a reversal, right? Though I'm still quite bullish, and I actually think that this zone right in here, this 80 to 82 pocket, is a buy on dip. And I think that like I was saying for 3 weeks in a row, that you can't buy the rip because there's no asymmetry in it. They're like, you can squeeze a few dollars, you're gonna get caught in a pullback. But now that this thing has killed $13 in a span of like 5, 6, 7 days, this is now where the corrections happen. I mean, fine. Can this thing drop from 83 down to 80? Yeah. There's probably $3 more downside where you're going to have to stomach a couple of swings lower. But it's no longer in the 90s. And I think it should be bought on dip. You have a different opinion?
No, I don't have a different opinion. I do have a smart subscriber of mine actually highlighted a few weeks back. He said, I don't know why crude oil's ripping, because I really think that Biden's going to make a deal with the Saudis to get oil down for his election. I thought to myself, actually that makes a lot of sense if you kind of think about it. Everyone was focused on the fact that the Saudis were going to really stick it to Biden going into the election and tamp down supply and cause a rally in the currents in the commodity. But if you think about it from Biden's point of view, why doesn't he just give whatever he needs to behind the scenes and get them to pump more oil to get oil down? And I think there's a lot of geopolitical kind of maneuverings going on here, Patrick. I think even the rally had the feeling to me that it was the Saudis jerking it around. If you look at kind of the underlying fundamentals of kind of oil.
Okay, well, let me rephrase
in terms of the products. 1 second, the products, and like the crack spread was really negative as they rallied it up, but the products weren't leading the way, and so that
the crack spreads fell under $10. Like, I mean, we were down like $6 to $8 at one point. Like,
but that to me shows that the rally in the crude wasn't as real as people thought. It wasn't demand driven, at least.
Yeah,
and
I get it.
And to my point is, I'm not disagreeing with any of your kind of technical analysis there, and I'm not saying that you're not going to be right and that it doesn't go a lot higher. What worries me, and there's rumors and kind of rumblings about it now, is that Biden is negotiating and there is a deal, and maybe oil actually gets down in the coming months because of that, and that's what worries me.
So I realize, but I mean, okay, do you think that there's a downside risk back to the 70s?
Yes.
Ooh, interesting. Let's see if it plays out.
I'm also probably more bearish about the global economy than some now.
Well,
which I think is funny, because for the longest time I was the big global, economic bull, and I find myself in an awkward spot where everyone seems to be most bullish about the economy.
I'm actually on the economy as bearish as you are, but to me, the stock market will only correct when it's time for that. Like, you could have the economy starting to roll over for months, and the stock market won't give a shit. And then suddenly the stock market will happen.
But oil might be a little more sensitive.
Yeah,
And I realize that usually oil it's the other way around. Usually oil rallying
causes the economic
economy to roll over because the central banks have to tighten against it. But maybe that rally is what all those cycles and all the way it usually works. They've all been thrown for a loop because of COVID.
Yeah.
I think that's one of the problems a lot of people are struggling with here, Patrick, is that we had, let's just think about it. We shut down the economy. Then we turned on the ability to buy things. We gave everyone money. They turned on the ability to buy things, but they weren't allowed to spend it on services. So everyone spent twice as much on goods, but nobody was able to produce it. So we had inflation there, and then they let everyone out, and then all of a sudden all the services ran because there was nobody to, everyone wanted to go out and eat, and the cycle's messed up.
Yeah.
Like we're all trying to apply the playbooks from old cycles, and the reality is that they just don't work right now because it's all messed up. Dario Perkins said this right. Like this is not a regular cycle. So I'm always a little bit kind of hesitant to say, oh, it's going to look just like the last one where oil rallying causes the economy to roll over.
All right. What a drop in gasoline futures.
Yeah, and there's to my point, right? Like that's
isn't that insane? 50 cents in 3 weeks. Like that just the magnitude of this drop and the speed, the velocity is unbelievable. This is what obviously hammered the crack spreads, but what a drop. Unbelievable. It's actually a stone throw away from its May and June, July lows. It's unbelievable that it got down here that quickly. But I want to talk about this reversal in natural gas.
You're going to goocher my trade, aren't you?
I'm not goochering it. I wanted to observe a fact. So
okay.
I wanted to observe that, first of all, nat gas was shockingly weak through August and September on the winter gas. We're looking at a December contract. Obviously, it's not the Jan Febs and shit like this, but usually you're already rolled up the term structure by December, and so yet this contract made fresh lows in September. And it was basically pricing giving away gas. So there's a huge supply excess going into this winter. And this reversal, I think, is very interesting because it is testing what I call a very critical zone. This 360 area is not only the fib zone, but it also is kind of where the high volume nodes of this entire consolidation lie. And so if this is a real rally, it will blow through this zone. And if you get up to 380 plus, and then it starts holding all pullbacks above 350, then this could be like a big inverted head and shoulders pattern that could start to signify that nat gas is actually a big bottoming formation, may go higher. Obviously, you're probably going to have to move forward to later contracts in December, maybe farther out into the the Jan, Feb, March, April kind of contracts. But what a reversal. That's a crazy 2 days.
So I want to talk about this a little bit because I've been highlighting this and writing about this in my letter. The Boyle ETF, which is a double ETF on nat gas, which is kind of like you might as well put the...
You want me to do it?
Shoot it right into your veins when you're trading this. But
because there isn't enough volatility in nat gas alone. Why don't we just go 3 times exposure on naked calls on this thing?
Right. This thing has a market cap of $1 billion, and that's making a huge amount of negative gamma out there. And if you look as a percentage of the open interest, it's abnormally large. And although it has been larger, but it's an abnormally large amount of the front month, although you have to be careful because it's not always the exact front month. Yeah. It's the most active month. But I'm worried that this is going to cause a situation where it feeds upon itself, and it wouldn't take much. Yeah. Although technically it could happen.
And why are you worried about that when you're long?
Well, I'm not worried, but I am saying that the potential there, and I don't think enough people are talking about it or realizing how big that Boyle ETF is.
Yeah.
Like when everyone goes and rushes into the TLT, which is happening, and it's expanding its assets under management, that's all a single kind of delta ETF, meaning that there's no gamma to it. Yeah, it's helping stabilize the market at by
But this is double exposure.
But this double exposure, which means that to maintain the double exposure, they have to buy more as it goes up. So, today, yesterday they had to buy X number of contracts. I don't know what it was, but today they have to buy another X number of contracts because it's up, and it becomes self-fulfilling and it feeds upon itself.
Yeah.
And so just be aware of that.
Yeah, yeah.
And one thing I will say is that for me, I'm long the contract that the Boyle is long because I think that's very important. I think the curve could get
Are you saying are they doing the front month?
Yeah, so it's not exactly the front month.
Now?
It's always they roll it into the month with the next most open interest. So, for example, they were long SEP, but for some reason they rolled from SEP into November.
Okay.
Now I think November they're going to roll it into December because December has it's very liquid. So there are times that it goes kind of 2 months out.
They use a little bit of discretion to go to the...
Well, it's not discretion. I think it's a rules based upon the prospectus.
Yeah.
But you're right. It's not always just every single month. It's the next most liquid month or the one with the most open interest. So for me, I'd rather be long, even though I understand the carry about being long the front month. It hurts. But I'm worried that if you go by, let's say, June of next year or even March of next year, and then we have a squeeze in this thing, it'll occur all in the month that they're long.
Right.
And so I'm worried about this curve getting weirdly shaped because of these guys.
All right. Let's talk a few more things. Copper. And got to bounce. If risk assets go, this will finally retrace. It's held its previous low. We'll watch. I want to talk... obviously, uranium, the U308 contract pulled back from 74 down to 70, but the U.UN had a little bit of a washout. I mean, I think at one point, was it not close to, a 10% discount to spot?
Yes, a little bit of volatility there in the NAV to
whip back. I still think this is a very bullish-looking chart. When you have this kind of a rally after a 2-day sell-off, that usually means it's not done. I would watch to see whether Cuppy's loading in here, and he's probably like half the market on this. We'll watch, but clearly that discount got a number of traders interested, and they piled in pretty quick. So it'll be interesting to see whether. I wanted to just touch on one more index, and that's the rare earths ETF, and it's been a bloodbath out there if you haven't been an energy stock or a uranium stock, it's been ugly. And this is one space that has just had it rough. Going from basically that's a 1/3 wipeout from 90 down to 60 in a span of 2 months. And it'll be interesting to see whether this is oversold enough in these conditions to get a bit of a bounce. Do you have something to say, or can I go on?
Well, just about the bloodbath that you saw not the bloodbath, but the decline you saw in the U.UN or uranium stocks. I think that there was something big that occurred in the first 3 days of the month, Patrick. And if you pull up XLE, I think that'll exemplify it.
Yeah.
We had this kind of selling. And to me, it felt like it was a selling in all commodities that started the first day of the month, and it actually crescendoed Wednesday, I think.
So
we saw it in Canada.
A big player just rebalanced.
I think it was a huge player, like some big sovereign wealth fund, because it was just all the commodity trades were for sale just across the board.
Yeah.
We saw it. I think it was even more than just commodity plays. I think that they were selling commodity countries. We saw just huge volumes in Canada. People puking it out. And it really felt like to me on Wednesday that it finally, the order got filled and that the balance traded, and then Thursday was okay.
Yeah.
But a lot of these commodity trades, and it was weird that it happened in the first 3 days of the month. Like you kind of expect that to be a month end or quarter end. Like but it's like somebody got up and said, okay, you know what? Let's sell some more commodities and buy Mag 7. Because that's in essence what the trade was. It was selling all the commodity, real economy stocks and buying Mag 7.
Yeah.
And you can see it in the charts. Like if you go pull up, you can't get it, but there's like a Goldman Sachs commodity sensitive index that I like to follow. And that thing just went no bid. And at the same time, Mag 7 went bid.
All right. You know what? I want to talk about the Mag 7. Just quickly, I wanted to touch on the bonds. It's still very weak. And even though they bounced a little bit when the risk assets turned here, this is still a very ugly chart. And it's going to still take a bottoming formation to get this to turn. It'll be interesting to see whether or not the selling subsides with if this whole market is just stopped selling on the short term. But what I wanted to really highlight was what happened in high yield. Just the junk bonds finally broke. It was ugly. You saw the spike in the high yield credit spreads as we went from like 380 to almost 4.5.
Well, I don't know, Patrick. You call that a spike? Yes, it's up.
It's up. But the
you've
fact
been hanging around your Doom podcast too long. Like that's like
okay, come on.
No,
like that, it was ridiculous that it was that low in the first place. Look at the drop on this price. I mean, you had from 92 down to 88. We haven't seen these price levels all year. Like this is the low 2023 low. Don't try to brush it off like this isn't important.
No, but what I'm saying is on the credit spread portion of it, it's still within the kind of range of
absolutely. It's not doom until it's north of 5. Need
go back 1 second. Can you see it? Can you show me the spread again?
Yeah,
north of 5. Yeah, I would say if it. I would say even at 450, 460, 470, we start to get worried about it. We're not there. But not only that, today we bounced.
But like if you go back and look, like it's when you get really north of 5% that something is wrong. Right. Like, and so you're right that, a spike from 380 up to 430 is not yet outright alarming, but it's the first time in months where junk bond has done worse than Treasury.
Okay, fair enough. So you're just saying put it on your watch list.
I think that this is. I think it's important. But what I wanted to talk about these FANGs, like let's talk about something like Google and stuff. Like Google has brushed off this entire little decline with a quick little retrace to retest August lows, and it's back to its 52-week highs. Like these FANGs are still taking flow, and to me, that is something that is a plus for the bulls. It means that there isn't huge exodus from the markets. It's just they're going into the defensiveness of this space. They're all crowding into the things that are holding up, and they're avoiding the shit that's going down, right? And so it's kind of like it's an interesting scenario, but it's not bearish.
I think, Patrick, though, what you said there in terms of the defensiveness of the FANGs is just like, you're right. And I'm not disagreeing with you that they are trading like defensive names, but that's just,
I think if you stop and think
about it, that you're buying a 35 times sales company, NVIDIA,
as a safety trade.
Yeah.
But the safety trade is that if everyone else has no alternative but to own them, and they stay with them, and nobody's selling, then you're safe, right? Like
100%.
Like so,
I'm not disagreeing with your analysis of it. I'm just saying
ridiculous
that when you stop back and like if you have a longer term perspective of markets, you have to be saying these need to be sold.
Oh yeah, if you're Jeremy Grantham and you're like looking at this, you're like, oh my god, right? Like this is not good. I mean, we're just retail.
Like, we're just retail. Like if you're able to sit through not participating in the next, let's just say 30% up move in these things, and you're more interested in absolute returns and risk reward as opposed to beating or maintaining an exposure to the benchmark, then you should be. These things should be sold.
Yeah. All right.
Anyways,
we're moving on. Tell me you picked something for Krayons with Kev, or was that a one-time thing?
No. We're going to do Krayons with Kev.
All right. What stock you want to look at?
TSM.
Okay.
Taiwan Semiconductor. Trying to do stuff that I don't actually have a view on.
Okay.
And I'm pretty sure one of our subscribers or listeners recommended this one.
All right. So
I tried to find the email and I couldn't. And there's a chance that it was another stock and I screwed up.
Do your technical analysis. Tell me what you see.
Well, so I'm looking at this thing, and obviously 2022 stunk. There's no doubt about it. It was like straight down the whole year. But since then, we've gone and we rallied into the year end, and then we've had a series of kind of higher lows and hooking back up. And like when I put the 200-day in there, it's like just slightly above for where we are here. Putting in that 200-day.
There you go.
And I'm thinking that if I was going to trade this purely from a technical perspective, if I saw a period where it like broke above that 200-day and held, meaning like the third day above the 200-day, I think you should own this.
Okay. You know what? So can you give me context in terms of are you talking about a longer term holding or a swing trade or
no, this would be something that I would expect that to me, it looks like a series of higher lows. And I would say, we had to move to 110. And so maybe you get to move to 120.
Okay. So number one, so you could look at the downwards channel, lower highs, lower lows. That's been a downwards.
Oh yeah, I missed that.
A downwards channel that could actually be bullishly broken out. So if that channel bullishly breaks out, the first thing would be you would expect it to retrace the sell-off. And the interesting part about the 50% retracement of this Taiwan semiconductor is it lines up with the highs from February. And that could be a level that puts in the right shoulder of a big head and shoulders pattern. So while on the short term, a trade back towards 100, I think is actually a very reasonable upside trade if it can get above the trend lines and stuff. But I would be 1 foot out the exit door that if this thing can't clear 100 on the upside, I would end my journey on the stock very quickly.
That's why they pay you the big bucks. I like yours better than mine.
All right. Okay. So let's talk skin in the game.
Oh gosh. Well.
Okay. Hold on. No. What do you mean? Don't say anything. Lena, hop on here. So this was the final bet. So we bet the U.S. dollar yen 148.28 over under. Lena, what happened?
Drum roll, please. The winner is Patrick.
Oh, look at me fuck up the slides. No.
Oh. What's up?
There we go. Kevin.
Yeah.
You folded like the Toronto Maple Leafs in a Boston game.
You know what? Or the Blue Jays. It was very fitting. It was very fitting. I was up 14 points or something like that. It's just like the Leafs with Boston up 4-1 in the third period.
You were at 49 points.
For
49 points.
Couldn't win a single one. I choked.
You choked. All you needed to do, it was like being on the, you're 1 yard away from a touchdown. All you had to do was get your guy in there and push 1 yard, and you couldn't do it.
Well, good for you, Patrick. You came up with some great trades. I screwed up on the one I feel bad about. I don't feel bad about this one because this one actually would have, I feel correct in my bet, and I was really close. And if I was hoping the Bank of Japan would intervene more than they did, and unfortunately they were a little soft. But I really go back to 2 weeks ago or 4 weeks ago, whenever it was, when I had the bond bet, and I bet against my long-term conviction, and that was really the one where
cost you.
I should have been over there, and I deserve it. I deserve to lose purely on that one bet.
Well, you almost won.
It was an amateur move.
So you know what? We've been betting this for like a half a year to get to this point, and I still am confused on what I won or what you lost.
You didn't win anything. I have to take out the listeners. But you like going out so much more. I should just let you take them out.
Listen. No, we made the rules. You made the rules. You're gonna have to do this. We can mix it up a little bit and change it for the next round. But this one, so you're the one that is going to take out 3 listeners on your bill.
That's correct.
All right, that's fine. I get to take
We're
the
going
knee.
to go to a craft beer place. I've already decided.
So it's going to happen in TO, right? All right. So
right.
like, what are we doing? So we're going to have people submit to be one of the 3 people. How are we going to play?
So I guess we'll say you have to be available. What should we do here?
I'll tell you what. Let's announce it next week.
We'll tell the details next week. We're not.
Yeah, or the next episode. What we'll do is we'll give all the details where people can submit and how the 3 people unlucky winners will have to get stuck with having dinner with you.
Yeah, and we'll drink some craft beers and we'll have a great time. And we'll talk about what a bum you are.
Thank you.
Anyways, congratulations, Patrick.
All right. You know what, though? I say we don't make a new bet this week because we
might have a whole new segment.
Exactly.
Right.
Let's actually rethink as to whether or not there's a room for improvement on the way we run it. So let's not make a new bet
I'm
yet.
thinking that we actually don't do bets for a while. We'll come up with something new and fun to do.
All right. Okay. So it's time for No Stupid Questions. So Lena, save the day.
I don't know if there's much saving to do here. But first question. Hello, everyone. Do you have any insight on the duration characteristics of the RRP when it comes to where those dollars can go? My impression is that the vast majority of that liquidity is, by mandate, locked into very liquid and short duration paper and cannot chase out the curve. So issuance of bills by the Treasury will get soaked up by RRP, but issuance of further out will not, and the RRP should not be looked at as a safety valve for longer duration issuance? Or will there be a natural movement out the curve from RRP liquidity when we start seeing cuts? Thanks and appreciate you guys.
So that's the reverse repo they're talking about.
Right, and I'm going to take this one.
Yeah, thank you. Because, no, absolutely not.
Okay.
I would give an absolutely stupid answer if I...
This listener is bang on correct that the reverse repo is a very short term. Most of it, I think, is rolled night overnight. I think there is a little bit that's a week long, and that is in essence a money market instrument. And those that are investing in that are either buying bills or short-term commercial paper of some sort, but they cannot go buy 30-year paper or 10-year paper, or even 5-year paper, most likely. Yeah. Now, having said that, there are some people that can, and do buy both, meaning that they have a mandate to be wherever they want on the curve. And if they think that the 10-year paper has finally got to a point that they want to lock in that yield, they will go and switch from their RRP into the long end. So, but that is very minimal. And this listener is spot on correct that most of it is actually just funding trade, and it's at the front end. But what's amazing about this, by the way, is if you go look back 6 months ago when everyone started to get worried about the RRP and get worried about the TGA, which is a Treasury General account, and how those both were going to cause liquidity to be got sucked out of the system. And you look at, let's just say, one of the big sell side firms and look at their estimates of where we would be. They thought there would be like $1 trillion of liquidity coming out of the system with the combination of an increase in TGA and then a flattening of RRP. Instead, what's happened is the TGA has actually increased a little bit more than they expected. But having said that, the RRP has declined so much that there's actually been no change in liquidity during that period, or very little change in liquidity. And I think that's amazing. And it just goes to show you that when it hits the front and everyone's talking about it and there's all this worries about it, it's often very much priced in. And it'll be really interesting to see as that RRP goes down, as they do more QT, how the market reacts. Because at that point, there will be no more ability for the RRP decline to push liquidity into the system.
There you go. All right. Next question.
Okay. Hi, crew. REITs and other dividend payers have been crushed recently. Many constantly quote rising interest rates as the reason for the downfall. I understand that debt rolling will be an issue for many companies, but the most quoted argument is one of yield comparison. Is there any merit to this argument? Are rates really going to stay this high for many years to come? What does a macro fortune teller and a crayon wielder have to say? P.S. I love that the dollar-yen trade is the one to decide it all. So excited.
No, now he's already heard the result.
Why don't you start crayon wielder there?
Well, Look, these special. I've tracked more the mortgage REITs than the other ones, and obviously shapes of the like whether there's inversions and all sorts of other yield considerations are there. I mean, when bonds are weak, these are bond proxies that have sensitivity to rates, and so this is a very difficult time. The question though he's asking is that can it stay high for many years to come? And this is where me and you will, throw down the gloves and have a bigger argument, because while I think higher rates can stay here for an intermediate period, not short term, but an intermediate period, I don't think that our existing system can sustain these kind of high interest rates without having to alleviate it down the road. And obviously the sticky part against that will be inflation rates, right? And this is where I'm sure you're going to go. But I think that there's going to be a buy on dip on these, but it's not yet. At this moment, I think they can still get worse on the short term.
Well, I'm going to say it doesn't matter whether rates stay here or not. What you're experiencing is people switching. And the real question is, so if you think rates aren't going to stay here, do you want to own REITs or do you want to own treasuries? And what you need to look at is the relative kind of merits of REITs over treasuries. And it's going to depend on a lot of things about your view of inflation, where you think that the REITs should be traded at, yada, yada, yada. But the point is that they're trading on a relative basis, just like Patrick is saying, talking about the high yield and how it's trading at a tight spread to risk-free rates. I feel like the REITs are just experiencing kind of their first widening against those risk-free rates. And I'm kind of nervous that it's not just the REITs were the first in the shoe to drop, but the whole world kind of has to reprice a whole variety of different assets against the fact that the largest risk-free rate in the world, like the 10-year U.S. government treasury, has increased 100 odd basis points or whatever it is over the last little while. And it feels to me like maybe the REITs were the first to do it, but there's going to be a lot more assets in the future that have to reprice lower. So anyways, I would think about it more like as a spread to governments. I wouldn't think about it like if you're really bullish on rates, then maybe you should buy actual government bonds instead of REITs. And I'm not like, I don't know. I'm just saying that they're two.
And it's also the types of REITs, right? Like obviously commercial REITs versus residential versus mortgage. There's all sorts of dynamics.
REITs
in there.
Are a little bit. They do have over the long run an inflation component because it's a real asset.
Yeah.
So it depends on how you expect the kind of real asset versus a financial asset to pay out as well. Next question.
All right.
Next question. So, dear friends, my U.S. broker wants me to allow my stocks to be lent out for short sellers to use, and I will receive some of the fees that my broker gets.
Don't do it if you own AMC. Just kidding. Just joking.
It seems too good to be true. However, I see that my shares will no longer be protected by SIPC. If the broker that is borrowing the shares goes pause up, I may get back the value of my shares when they were lent, but not the shares themselves. I would miss out on any gains made while they were lent. Is this true? Are there any other dangers? If I tell my broker no, will they still lend the shares out but not pay me? If that is the case, do I still have the same risk as above? Love the show and your guests. If I had only one podcast to listen to, it would be Market Huddle.
Yeah. Oh, that's really nice.
Oh, that's sweet. So I'm going to let you answer the most, but the question I have for you, Kevin, like, isn't it, like, I know in Canada, isn't it like by default that when you open a margin account, you allow your shares to be lent? Is it not like
correct.
It's pretty standard.
That is in Canada, and we're not going to speak to the U.S. because I'm not sure.
I'm not sure. Yeah.
So if for example, in an RSP, which is like our 401k, if it's fully paid, it's not margin, then by law they cannot lend those out.
Yeah, it's margin.
Then the question ends up being, and let's just assume for a second, and we're not sure about it, but let's just assume that's true, that if you have a margin account, the broker will lend it out to you, regardless. Then I guess, if that's the case, then there'd be no sense in not getting paid for it. The only account that I've ever seen that actually does this is Interactive Brokers. So I'm assuming that's what this client is using, or this listener is using. And one of the questions you should be kind of concerning yourself more with, instead of worrying about the kind of intricacies if your broker goes bankrupt and what's going to happen to whether you lend the shares out or not, I think you should kind of look at the broker as a whole and go through if you're above a certain limit, and because there's a certain amount. I think the first $1 million is covered. Is that right, Patrick? Something like that. The first $1 million is covered. And then after that, it's like, you know, the next 25 is covered by Lloyd's of London, I believe, in the case of Interactive Brokers. But it's going to be a shit show if the broker goes under. So I don't know if I would not do it because I'm worried about that. I would go with a broker that I like, that I trust, and then I would get paid for it, especially if I was owning shares that were trading with a high yield. I mean, a high borrow fee. I shouldn't say yield, borrow fee. Yeah. Because there's a lot to be said for that. So
all right. I agree with you.
I go look into it some more. We don't have it, obviously you got to go check with like an actual lawyer if you wanted a proper, like, oh no, you're protected. And even then they'd probably just give you an opinion. But
yeah, they wouldn't be able to tell you anything certain.
I would be more apt to just find,
because, like, think of the circumstances that would have to happen in order for the kind of a shitstorm to be there that other financial institutions wouldn't be there to bail out another one. So if it's like a one-off, then there's always some way that, the New York Fed in their little country club get together and somebody goes and absorbs a different broker and does something. So when it's just like a one-off, they can always bail it out to keep the integrity of the system. In order for there to be an issue where you as a retail investor are the bag holder, that has to take a pretty cataclysmic event.
You're absolutely right, Patrick.
Right? Like,
now, having said that, there are nuances, and this listener is correct to kind of highlight the differences in terms of what positions you have and what you've agreed to. Like, I remember in Refco's case, when they had trouble, like Refco Futures was under, if I remember correctly, Refco Futures was under the NFA or whatever it was, and those people got their money all out completely. Whereas if you were in Refco Foreign Exchange, that was an unregulated entity, and you were left holding the bag. Yeah. Same with Lehman. I remember if you were Lehman, if you prime brokered at Lehman New York, you were a lot different than if you prime brokered in Lehman London. The trouble is that most people prime brokered at Lehman London because it offered you more kind of leverage, and the reason that they were there was because they could offer, kind of skirt the rules more. So the more you're outside, the kind of cookie cutter, and the more you're trying to get something, the more risk you're taking. So the listener is bang on correct for thinking about those things and examining that. I just don't know if it's Interactive Brokers. To me, I kind of feel like either they're going to be a problem or not going to be a problem. And I suspect that regardless, unless your account's like really large, they have more than enough insurance. And not only that, it seems to me that Interactive Brokers is a well-run institution that seems very concerned about their credit risk at all the times. And it at least it would seem to make sense to me. Or let's put it this way. On my Interactive Brokers, I lend my shares out. And obviously everyone has to decide for themselves, and I'm not suggesting you should do it, but for me, I think the risk is worth it in terms of getting a little bit extra security for that picking up of the
perfect
fees.
Lena, where can people submit their questions?
So if you have questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. You can check us out on X, Twitter, whatever it's called, at the Market Huddle. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. Kev, where can they follow you?
You can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Now stick around for the after show. Patrick, I'm really proud of you, buddy.
Why? What?
Because you were so giggly, and I was worried about how many drinks you'd had before.
You know what? The wine wore off before.
Weared off. Oh, yeah, weared off real good.
real good. Listen, I'm actually really happy that I didn't get a skunky Heineken. because I have a much higher track record of being disappointed than not. I'm not going to rate the beer because everyone knows what Heineken tastes like. It's literally.
I don't know why you guys are all so negative on it. It's a fine beer.
I've had worse.
No,
I've had worse.
I'm sorry. Like Heineken. Okay, so when you get a fresh Heineken, and let's say you're in Amsterdam, and this thing is like a couple weeks old, been freshly bottled, and you have this nice lager, it's a nice clean beer. But they ship these green bottles around. Some people, some of the stuff online is the UV light, the green doesn't reflect it properly, and it's the fact that it was no preservatives. There's only the 4 core ingredients inside the beer. If it's been on the shelf too long, and so Heineken has a reputation of spoiling. And so a lot of times, when you're in foreign countries, you're going to be the, bag holder of shit beer. And so it's a hit or miss with the beer. When Heineken, when you got a good fresh Heineken, it's a good beer. But it literally is a lottery.
But it never stays on your shelf for too long.
Yeah, for sure. Absolutely. But listen, it's it. I'm not going to rate it. Everyone. It's crazy, man. What an amazing city. But have
you seen any police cars driving Lamborghinis?
No, I have not. I have not. Yeah, they do. But it's what an entrepreneurial city.
Did you tell Kevin how you had such a very Canadian experience in Dubai?
Which one? Oh my God! Oh yeah. I basically I went to the Dubai Mall, and. And one of the right on the main floor is this huge, massive Tim Hortons.
Come on.
And right behind it is their in the mall skating rink. So I'm in Dubai, and I grabbed myself a large black coffee. And I grabbed a black coffee and went and sat by the hockey rink and watched some people skating.
That's wild,
right? You know what? I haven't had a Timmy's in how long? It's still shit coffee, but I mean, listen,
no. Timmy's is great.
No.
You know what? I used to hate it. I used to think it was the worst coffee, and it just proves that if you just drink it long enough, you'll start to like anything.
That's exactly it.
I'd probably, if I kept drinking skunky Heinekens, I'd probably appreciate them over the long run.
In Lisbon, it's like they only serve espressos, and so the idea of getting a brewed coffee is a rarity.
Not only are you a beer snob, you're also now a coffee snob.
Yeah, so just having just having that quantity of coffee. Normally, you just get yourself a double espresso, and
it's a good thing you won the bet, so that some Torontonian doesn't have to listen to your douchebaggery.
Oh man!
He goes to Europe all of a sudden. He's wearing scarves and talking about coffee.
Wearing scarves.
God help. What do you skate? Was it all Canadians? Listen, it's kind of like the way I picture that is it's literally the 25 Canadians that live in Dubai are there skating every single day.
No, it's a tourist gimmick. So the thing is there's a lot of tourists from all over.
People trying it for the first time.
Yeah, and
do you know what's funny?
There's a lot of Ukrainian and Russians here, so there's always going to be someone who knows how to skate.
I hope they separate those two when it comes to skating. In New York City, Patrick, what's funny is that when young guys go there, like Canadians, they get a job on Wall Street and stuff, they all end up knowing each other. And do you know why? No, because they all play in the hockey league. It's literally it's half Canadians, like the house league kind of hockey, league.
Yeah,
it's all the Canadians. It's like a Tragically Hip concert in New York City. You go there, and they obviously they don't do any, but there'd be a hip concert, and you go, and it's just all Canadians going to see the hip. It's true.
True.
Same with the hockey and the skating. Well, how's it otherwise? And is it hot? I've never been in stupid hot. Is it
it's stupid? It's stupid
degrees?
hot. No, like it's under 40, but it gets like 36, 37 during the day, 27 at night. But it's not actually that. It's actually surprisingly it's very humid here right now.
Really?
And
I thought
so
it was like a desert.
no,
I guess it's not.
the
It's
humid,
on the ocean,
like
right?
literally, I walk outside and my glasses fog up instantaneously because you're going from like they got the air conditioners cranked inside the hotels and everything in the malls, and so you walk outside into that heat like instantaneously. It's like it's like walking into a wall.
Wow.
Like the
That's
thickness
not what I
of the air.
expected, but now that I'm looking at it, it's on the ocean, so makes sense.
Yeah, it's but you know what? It's still actually, you know what? It's an amazing city, and you know what? By the way, a shout out. I had a little Huddle piss up with a bunch of listeners.
Oh, great! How did that go?
It went great. A shout out to Paul, Andy, and Joshua who showed up. Canadian and two South Africans. They were members and listeners, and they heard that I was going to be down here, and so they reached out, and so I met them up for a beer. And great listeners, we had a great time
all over the world.
Yeah. Like you know what? There's honestly, it's very hard. I've been here for 4 days and I have not found a single craft brewery place. But we went to an English pub and they had Guinness, so that's where at least I had a proper beer to drink.
I wouldn't think that there's any breweries there, period.
No, but like you would think that they would, like there's a lot of craft breweries that are larger volumes where they will export, right? And so at least you can get bottled beer of different types around, and it just, it's not a thing here. It's not a thing.
I'm just looking at the map here, Patrick. This is what you're going to do. You're going to get a car or an Uber. I want you to drive to the top of this peninsula and go look at the Strait of Hormuz.
Okay.
That's where there's going to be some shit someday that'll happen, and you'll be like, I was there.
All right.
That's one of the busiest shipping spots around, and that's where they have to go around, and that's where, if there was ever a geopolitical conflict, that's where it would be.
Yeah, that's
for oil.
Yeah.
I remember Marco Papic told me that. He said, well, he was talking about China, and he was talking about if they ever invade Taiwan, he said, what's going to happen is the U.S. is just going to sail a whole bunch of aircraft carriers into the Strait of Hormuz, and they're going to stop everyone from going to China with the oil. And I was like, oh, wow. That's pretty cool, actually. Not cool, but like interesting. The geopolitical chessboard.
Well, it is.
You're in one of the kind of key spots.
You know, and this is why they're probably stockpiling Russian oil. Like they need to have a buffer, right? Like just in case something happens, they need to have reserves. They're building their SPRs with the opposite of what U.S. is doing.
They're just saying bought from you.
All right.
So what else is you got to tell us a little bit more. So I'm looking at this. What else have you done there that's been fun? Why are you there? Are you just like cruising around, or do you have like one of your?
I've got my own reason. No, actually, I happened to cross paths with the guy that I'm cheating on the other podcast with you on.
Oh God, you're there. That's what it's for.
No, it's not.
You guys are doing your crazy like.
I'm not. I'm actually not involved with anything he's doing, but it just so happened that
you're there at the same time.
Yeah.
So I'm calling bullshit. I'm calling bullshit.
No, listen. I
went halfway across the world to a country that I've never spoken about or just showed any interest in doing this, and it just happens to be that the guy I'm cheating on you with the podcast is there as well. But we're not doing anything together. Sure.
I'm gonna just shut up.
Oh, they got an Atlantis. You got to go to Atlantis, buddy.
Dude, I'm right beside it. The W is just right around the corner.
Well, what are you doing at the W? Go to the Atlantis. Go on the lazy river or whatever it is.
All right.
Oh man, this is awesome.
I hope
I'm expecting you to
go to honestly, this Palm Island is freaking insane. The fact that this is
that's where
built
you're
this.
At.
Yeah.
Oh, I'm looking at it. The man-made shit. That's that's crazy.
Man-made shit.
No, it's literally
Google
I
it.
understand.
It's like
no, but It is pretty insane. But you know what? Like when you look on a map, you don't actually realize how big it is until you're actually on it. And this place, this island, is gargantuan.
And is there sand all the way around? Like, is it beach the entire sand?
The shoreline's all beach, yeah.
Wow. That's one way to make your own property. Just like, okay, let's go.
Yeah, I'm just going to go
and make our own beachfront property.
It's insane.
I'm gonna try that on
the Atlantis and the other Atlantis hotel beside it are like the largest hotels in the world, right? Like this is they literally just built this gargantuan city on a desert. It's insane. And you know what?
Sorry, is this Mission Impossible as well? Are you there? There's protocol. I'm looking here. I think it is.
Yeah. There was one of the Mission Impossible.
Yeah.
Where Tom Cruise basically jumps out of a building and climbs the side of the building?
Yeah, he Spider-Man's it.
He's on that, oh my God, what's it called? The most famous building there.
It's the
Burj Al Khalifa or whatever.
Yeah, there you go.
I'm
glad
probably
you pronounced it for me.
butchering it. But.
Yeah.
No.
That's right by
awesome.
the mall there. Yeah.
Patrick.
Oh,
this is what you should do.
Oh, tell me.
Get some goggles, some suction cups. See if you can make it as far as Tom did.
Oh my God. And then you're looking for a new co-host.
No,
maybe I shouldn't have dared him that.
Exactly. I didn't think he'd actually do it.
I had enough beers. No.
That's right. Oh my God.
No,
he did that in real life too, that stunt. He does all his own stunts.
Yeah, I'm sure he did it, but I'm sure there was plenty of harnesses to make sure that his body's probably insured for how many millions.
I think they don't even want him doing it. I think he has to fight with them to let him do it. And do you know how many? You know the recent one with the motorcycle? He did it like 8 times or something.
I saw that clip. Jeez, he's got like a death wish.
He did it with 8 times. Anyways, maybe he's just sick of Scientology and he's like, I'm going to check out. All right. Anyways, Patrick, congratulations again for crushing me on the skin of the game.
Oh,
well done.
I actually was so sure I was going to lose. Like the fact that I pulled this off is, I'd let you fall on your own sword. It's like I just had to sit back and I just let him do it. Figure it out on his own.
All right. Okay. Wow.
All right.
I'm going to talk about what a jerk you are when I'm with my 3 listeners, but that's fine. Anyways.
All right.
Okay. Have a great week, everybody. We'll see you next in 2 weeks' time.
Take care, everyone. All right. So what do you want me to type? Okay. Yeah, I'm struggling. I am so fucked. No, but like what color? Give me a color. White or orange? I'm doing it. There we go. Okay, so now, do you want it smaller, bigger, wider, thinner? Like, what do you want? All right, go. Jump in here and do it. Jump in here and do it if you want.
I don't know.
Take over. It's all yours. I see you DPing it. Just do it. I see your initials on there. Go.
Oh, God. Oh, God.
You have the best initials ever, buddy.
I know, right?
He's DPing it.